In a little while. There's a lot of expectation building around an ETF and whether the SEC will grant permission for that next week. This is the futures picture heading towards the start of the European trading day then. Looking for a little bit of divergence across these markets. FTSE 100 futures perhaps looking a little lackluster compared to the others. CAC futures suggesting a little bit more upside. Although I will say I've seen some fairly positive opening calls for some heavyweights in London, the likes of BAE, around what's going on in the Middle East right now, and also around some of the mining stocks, given what I was mentioning around iron ore prices being a little higher. So this is the start of the European trading day for this Tuesday for 2024. We see stocks out of the gates pretty positively, just up 0.1% or so, but waiting for some of the larger markets to open up, in fact. The CAC 40 is up by 0.5%, so that does seem to be outperforming the FTSE. The FTSE up around 0.2%. The Spanish IBEX looking fairly strong, up around 0.7% this morning. So we are seeing some of the peripheral markets doing a little better. The FTSE MIB in Italy up by 0.6%. So Italy and Spain doing very nicely. The French market not doing too badly as well. The London market a bit of a laggard, but we'll watch what the mining stocks are doing there. Interesting to keep an eye on all the geopolitics with oil prices on the rise. We see a green column for commodities there. I can see WTI and Brent crude, both of those moving higher this morning. That can play well for some of the London market. I see the shipping business Maersk also trading higher this morning in Copenhagen. So that's the picture across equity markets as we start another trading day. Let us get to the sector picture then and have a look at what we've got there for you. In terms of the sectors then, we are, as I mentioned, looking for what's been going on with the mining sector. That's in focus. In fact, all of these sectors are in positive territory, and energy is one of the best performers. So in keeping with that move higher in Brent crude, we're up by 1.2% on energy stocks. That's the best performing sector this morning across European stocks. Autos and auto parts also not doing too badly, up by 0.8%. Real estate, healthcare, financial services, all of those three are the least positive, but they're still in positive territory, even real estate. Pretty flat, but slightly positive. So let's leave that sea of green, muted as it is, but still a sea of green for the moment, and talk to Sophia Horta-Acosta from the Markets Today blog, who can take us through some of the thinking. Interesting to see that European markets opening with such positivity in the face of that negative data out of China. Perhaps that just doesn't touch the sides anymore. We're kind of used to that negative China news.
We are, and again, it's a confusing picture, right? Because the official PMIs was worse than expected. Economists saying actually the magnitude of that disappointment was larger than the magnitude of the beat for the private survey. Again, there's a geographical split there. But I was looking at, when you were saying, Anna, that Chinese shares were falling today quite sharply, I was looking at what they did last week, and they actually had their best week since July. So there could be a little bit of profit taking on the table there. Also, people perhaps looking at what happened domestically with the New Year spend, and that was not as good as expected. But that only really impacts China's economy domestically, not really feeding through to what we're seeing in European markets. I do think it's a big theme going into this year, and the latest MLife Pulse survey shows that a third of more than 400 respondents want to add exposure to Chinese assets this year, and that's higher than an August survey. survey and higher than a March survey as well. So it does suggest there's a little bit of appetite to get back into China, but that fragile recovery on the economy will be a big theme for global markets as well this year.
Yeah, it's interesting to think about what was driving that move last week in Chinese stocks. And Mark was telling us last hour it wasn't entirely evident. So whilst you and I were busy enjoying the festivities and some of the seasonal rain, Mark was saying that actually, yes, this was a big theme. Emerging markets doing pretty well in that week, and China was part of that, but it wasn't necessarily clear what was moving the Chinese part of the story. Sticking with China, a quick word on Xi's speech, because although that, it maybe weighs on sentiment that there's been an acknowledgement of the headwinds, it then leads people to anticipate some kind of policy response, and iron ore moves higher as a result of that. So what did you take away from Xi's speech?
I think you really hit it there. It's, acknowledging that there are domestic pressures, domestic headwinds is quite a rare thing for a Chinese leader to do. And he focused on what the youth are facing. We know that youth unemployment is near record high, at least because the government stopped publishing the data over the summer. And also the elderly, healthcare costs, and joblessness is a big problem. These were all mentioned by President Xi Jinping. There's an expectation that the government will do more in January, as soon as January, not just the government, but also the central bank in reducing interest rates, in getting that credit flowing to the real economy. That's been a struggle, the policy transmission there. But more expectations of more. I mean, that's always the story that we discuss about China, right? The data disappoints, but then the market pivots to expect something more and reads that positively. Again, that will be kind of the balancing act.
Okay, and then on to the UK. One of the things we're dealing with in the UK, food inflation, and our colleague Joe Easton was going through some of the latest data we've had on that front just in the last 24 hours or so. Things looking better from the perspective of consumers not wanting to spend quite so much on food. That seems to be part of the story.
Yeah, so Joe took the negative side of things because he's looking at the companies that might be impacted by this. This is obviously not good for grocers because it does suggest growing competition. But for consumers, the fact that one of the stickiest parts of the inflation basket is actually coming down is good news. There are a few caveats to this, though. This was December. There's a lot of discounting. Joe mentioned carrots, but other festive products like Brussels sprouts and potatoes were also heavily discounted. And also people are switching up. They're more savvy about their choices. They're going for perhaps own brand products and things that, really kind of focusing on where they can spend their money. And the other caveat, Hannah, is that it's still 6.7%. And after almost 2 years of a cost of living crisis, when you look at that number, that's still very high. It's taken a long time to come down. And while it is reinforcing a picture that inflation is at least moving in the right direction, I do think those best bets for interest rate cuts will perhaps be slightly optimistic if people expect the central bank to move, the BOE to move as soon as May.
Yeah, Sophia, thank you very much. Sophia Walter-Acosta from our Markets Today blog with some of the stories that they're covering on the Markets Today blog, of course, and the food price story is one of those. Interesting to see Sainsbury's and Ocado Group, two of the stocks that are moving lower in that sector, others doing better this morning. You can get more from the team that puts together that blog. Go to the Bloomberg UK website or type TLIV GO on the Bloomberg terminal. Coming up on the programme, ASML is in focus after a Bloomberg scoop revealed that the company cancelled some shipments of high-end chip-making equipment to China before an export ban came into force. We will bring you the details next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder. I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish trend has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
Welcome back. This is Markets Today. 10 minutes into the European trading day, the first of the year, of course, and we see European stocks moving higher this morning, up around 0.3% across European stocks as a whole. Let's get a check on the individual stocks that are on the move, though. Joe Easton has a briefing for us. Joe.
So we're seeing some significant moves higher in these shipping stocks this morning. Immerse gaining around 4%, and also Hapag-Lloyd 4.5% over in Germany. As we said, in stocks to watch, we have seen Maersk halting their routes through the Suez Canal and the Red Sea as well, following those attacks that were repelled by US forces over the weekend. And we're seeing a boost in a number of other shipping firms as well. Frontline is a company based in Oslo that moves oil across the ocean, and BP gaining more of a move following the rise in oil, but all related to that news of the halts to those routes, really having a big impact across markets this morning. Then we'll flip over and have a quick look at Nokia. It is negative once again, and it's just actually flipped positive. Interestingly, it was down 1%, but coming back up now. We did say earlier that stock fell by about 30% last year as they issued a number of profit warnings related to some contracts being lost, and they've issued yet another warning overnight saying that they will now not meet their previous guidance, but it seems to be priced in according to those numbers that we're seeing on the screen here. Wise is an interesting one. This is in London. This is the FX transfer company. News that HSBC is potentially moving onto their turf with a new online app is weighing on that stock this morning, down 6%. HSBC potentially moving into the retail FX transfer market. And in terms of the food companies, the last thing we want to talk about is food after the Christmas break. I made the mistake of stepping on the weighing scales yesterday. It wasn't pretty, but we did see that food inflation number coming down. That is a negative for those food retailers, but Marks and Spencer's gets an upgrade at Exane BNP Paribas. They say that they have gained market share over the Christmas period, so that one surprisingly actually outperforming. And Exane goes negative on Boohoo. This is online clothing retail. They say that pure play online is not the space to be in during the cost of living crisis, as people are looking to move back into bricks and mortar stores. So Boohoo downgraded at Exane. They prefer Marks and Spencer's. That one coming down a bit as well. Then a couple of other final stocks on the screen. These are ratings changes here. Lufthansa gets a sell over at Citi. They say that the recovery in long haul has actually now met its full expectations. They don't think that's got further to go. So they upgrade EasyJet. That one goes up to neutral, bit more positive on short haul, but still seeing some weakness, potentially due to the higher oil price weighing on the airline space today. Remy, this one, the price target cuts at Morgan Stanley. Once again, they think the outlook for spirits is negative. We saw a lot of profit warnings from that sector last year. And finally, Ferrovial. This is the Spanish toll road operator. News at the weekend that they have actually increased a number of their toll fees. This was unexpected, according to analysts. That's one of the best performers in Europe today for Ferrovial, up around 3% over in Spain.
Joe, thanks very much. From our equities team, Joe Easton, kicking off the new year with a look at some of the stocks on the move this morning. We also kick off the new year with some data out of China, and Chinese stocks are dragging down the Asian session on the first trading day of the year, following weaker than expected factory data. This comes as President Xi Jinping used his annual New Year address to pledge to strengthen economic momentum and job creation. Joining us now, Shamila Whelan, Global Macro Strategist at Westbourne Research Services. Shamila, very nice to have you with us. Happy New Year. It seems that the negative sentiment around China not weighing on European stocks, but let's think about where China heads, because it has been an important component of 2023 and no doubt will be this year. What are your expectations around the Chinese economy? Do you see any kind of green shoots at all? The data over the weekend taken quite negatively by markets.
Happy New Year, first of all, Anna. Good question about China. I think there are a few green shoots. Today's Caixin PMI overall index is in the 50-plus zone.
So that's the private sector. Yeah, which is a little more positive.
Which is saying that it's not contracting anymore, which is a downside farther down the line. Also, other thing is Asian exports to China have been picking up for the last few months. But having said that, the Chinese economy is struggling, particularly policymakers. They are struggling to offset the drag from incomplete economic reforms through fiscal and monetary policy easing. As we know, property markets in downturn, investment, credit cycles are in downturn, households and consumers are risk averse, and that dilutes and lengthens the impact of easing.
And that's interesting. So you contrast the structural reforms, which you say are still needed, with the policy response, which is often around the fiscal and the monetary. Does that mean that when we look to 2024 for more of the same fiscal and monetary out of China, it doesn't change the narrative for you, doesn't make you any more positive on China because it isn't about those reforms?
See, it's difficult, right? Because what do you do once you've got risk aversion set in? Because that's a mind and sentiment thing, right? And that's diluting your policy easing. The Chinese are extremely cognizant of two things. One is that they can't take another sledgehammer approach to completing reforms because that carries a risk of an outright recession. At the same time, the second one is they can't turn on the spending taps full flow, because they're highly cognizant of the risks of that when they did that in the aftermath of the global financial crisis.
Yeah, think about Europe, where we are here. I mean, this might be another conversation about trending along the bottom or bumping along the bottom, because we just had the Spanish manufacturing PMI, so I'll just throw that into the mix. It's the PMI reading for the month of December. It's coming at 46.2. It's pretty much on par with the survey, which is 46.3, and the same prior reading. So, I mean, not really moving very far on the Spanish manufacturing story. Does that tell a wider narrative around Europe?
It does tell a wider narrative around Europe, that Europe, I rather suspect, is already in recession. We saw it contract marginally in the third quarter, but now in the fourth quarter, because if you look at retail spending in volume terms, it's still contracting on a year-on-year basis. The property market is in downside, but more importantly, the credit, the corporate profit, and investment cycles are in downswing, which means companies are in a cost-cutting mode, payrolls, investment with implications for consumption and the wider economy.
Yeah, you make an interesting point in your notes that you say the key recession risk indicators to watch are actually around corporate profits, investments, and credit cycles. So what are those telling you at this point?
That they're in downswing in both the US and in Europe. I take a very business cycle approach to looking at it, and these are proprietary indicators, and they've worked rather well, and they're saying they're in downswing in US and Europe, which isn't great.
Yeah, not great. And how would you characterize the US growth story then? I mean, I was looking at the way that others are characterizing it going into 2024. JP Morgan and Vanguard talking about mild recessions, Barclays talking about a softish landing. So all of that seems, better than perhaps we thought 12 months ago. Deutsche Bank, on the other hand, still talking about a hard landing in the US. Where do you fall?
I think, expectations about the U.S. have certainly moved on since, as you said, 12 months ago, everyone was like, oh my God, there's a recession coming now. It's like a soft landing. Where is my view? I think that there is still a very high risk that they will get a technical recession, but it's more than just a technical recession, whether it's mild or not. Where is growth headed over the medium term beyond those 2 quarters? And I maintain the view that I've had for some time, which you must be bored of listening to, is that we're looking at several years of subpar growth in both Europe and in the US.
And where does that leave macro strategy then? If Europe and the US are looking at subpar growth, do you look elsewhere, or do you just pick the better options within those geographies?
Very interesting question, because right now, as you know, it's at least in the run-up to the end of last year, and I think even coming into this year, it's almost like risk on again, and that's because markets' focus has very much shifted to ECB and Fed interest rates, and instead of underlying fundamentals like what's happening to economic trends, corporate profit cycles, and investment, they're very focused on. So I think, and sounds ironic and even contradictory, but my view in terms of markets are that you're probably going to continue to see a broad-based rally led by the US and then Europe.
So from that, does that mean then that it's the Fed and the ECB and the Bank of England, it's expectations there that are actually guiding markets rather than the profit cycles?
Absolutely. I think markets are a bit optimistic about Bank of England, because if anyone is going to sit tight on interest rates, it's going to be Bank of England. So I think, the whole idea that Bank of England will be cutting before the summer is optimistic.
Do you think so? Why do you say that? Why the bank? Because inflation just...
Yeah, because the Bank of England is completely focused on inflation, and rightly so, right? And they're worried about wage growth, right? And that getting entrenched in terms of cost-push inflation pressures. While the ECB and the US, and particularly the ECB, the focus has shifted to growth. And if, as I've said before, if there is a trade-off between growth and inflation, they'll accept higher inflation.
Okay. Shamila, thank you very much. Thanks for joining us. Shamila Whelan, Global Macro Strategist at Westbourne Research Services. Coming up on the programme, we'll get a further update on ASML. It's in focus after a Bloomberg scoop revealed that the company cancelled some shipments of its high-end chip-making equipment to China before an export ban came into force. We will bring you the details next. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Will the ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimate, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome back. This is Markets Today. We are 23 minutes into our European trading day, and the European equity market story looks fairly positive, actually, despite some negativity being inherited through the Asia session, China weighing on stocks in the Asia session, but Europe going its own way and moving higher. Now, let's talk about a European corporate on the move. In a scoop, Bloomberg has learned that ASML cancelled shipments of some of its top-of-the-line chip-making machines to China at the request of the United States, and that was before an export ban came into effect. Let's get the details now from Bloomberg. Sarah Jacob, who joins us. Sarah, why did ASML cancel some of these China shipments then, even before this export block came in?
Good morning. Yes, Europe's largest tech company, ASML, canceled shipments of some of its machines to China at the request of U.S. President Joe Biden's administration, our sources have told us. So U.S. National Security Advisor Jake Sullivan contacted Dutch government officials late last year and Dutch official about the same matter, and the Dutch officials asked him to contact ASML directly about these machines. And these machines are called immersion deep ultraviolet lithography machines. The Dutch government then partially revoked licenses recently for the shipment of certain advanced machines to China, and that's affected a small number of customers there.
Okay, and why did the US push ASML to block these sales then, again, before the ban came into force?
Yes, so the U.S. has been sort of cracking down on Beijing's attempts to create an advanced semiconductor industry of its own. And if you remember, Bloomberg exclusively reported last year that China's Huawei produced a phone to rival Apple's iPhone, and that contained a lot of top-of-the-line chips, and that was used making some of ASML's lithography machines. So what this shows is that those export restrictions that may have sort of come too late to stem China's advance, and then the U.S. pushed the Dutch government to impose new restrictions, but ASML had a deadline up to Jan 1st to stop, shipments of those machines. What's we're reporting now is that what simply happened is that U.S. has asked the ASML to halt those shipments immediately.
Okay, and just briefly, the impact on ASML?
In terms of shares at Amsterdam Open, shares are sort of little changed, but it's not immediately clear how many devices are involved. Each of those devices cost tens of millions of dollars a piece. ASML, on its part, has said that it doesn't expect this to, have a material impact on its financial outlook in 2023.
Okay, Sarah, thanks very much. We're back. Sarah Jacob with the latest on ASML and the geopolitical tensions between the US and China playing out in the Netherlands. Coming up, we will talk about geopolitical tension in the Red Sea. Iran has sent a warship to the Red Sea after the US Navy destroyed 3 Houthi boats over the weekend. We will bring you that story, clearly having an impact on global shipping, of course, as well. And we're seeing oil prices a little elevated this morning, up by 1.5% at 78.14 on the Brent price. More on all of that shortly. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 30 minutes into your European trading day. Let's get your top stories. We are watching shipping and oil stocks as Iran sends a warship to the Red Sea after the U.S. Navy destroyed 3 Houthi boats. Shipments by Maersk through the waterway remain suspended. A Bloomberg scoop reveals ASML cancelled some shipments of high-end chip-making equipment to China after pressure from the U.S. government. Plus, end-of-the-year slowdown. Spain's December manufacturing PMI ticks further into contraction territory. We will bring you the latest reading from Italy shortly. Welcome back to the programme. So, yes, we're focused on the PMI story. That's certainly something we're monitoring, but that doesn't seem to be taking the edge off stocks today. So we continue to see negativity around the manufacturing story in Europe, but we've seen that for some time. Stocks focused elsewhere, it seems. The DAX up by 0.9% today. The Stocks Europe 600 as a whole, up by around 0.5%. So as you've seen, quite a lot of divergence across these markets. The IBEX in Spain up by 1.2%. The FTSE MIB over in Italy up by 1.2% as well. So some of the peripheral markets doing very well, doing better than the major markets this morning. So that's certainly part of the story. Interesting to see Germany doing so well. If we look at the sector picture, autos and auto parts is the best performing sector, and that obviously plays well for Germany. That sector up by 1.5%. Some of the best performing names within that space, though, not all in Germany. Volkswagen is there, but also Volvo Cars and Valeo in the auto parts manufacturing sector. Energy also up well, performing strongly, up by 1.3%. We have energy prices being echoed there. So Brent prices are at $78.09, and that is up by 1.4% compared to the previous close. So once again, energy having a strong day. Basic resources also performing well. The likes of, well, anything connected to the iron ore story, of course, we had expected to see that perform well on the back of higher iron ore prices through the Asia session because of ongoing expectation of assistance for anything to do with manufacturing over, or construction, over in China. That's part of the New Year narrative once again. Financial services actually the only sector in negative territory, and it is down by just 0.1% or so, so not by much, but the likes of EQT, Hargreaves Lansdown and 3i moving a little bit lower this morning. On to some of the geopolitics we're monitoring and the story behind those oil price moves. Iran has sent a warship to the Red Sea after the U.S. Navy destroyed 3 Houthi boats over the weekend. The move risks ratcheting up tensions and complicates Washington's goal of securing a waterway that is vital for global trade. Bloomberg's breaking news editor for the Middle East, Patrick Sykes, joins us now. Patrick, good morning to you. So why now? Why is Iran sending this warship now?
Iran says it's doing this to counter piracy and to secure shipping lanes. You'll notice the similarity there, and the second reason there with the US's own reasoning. From the Iranian perspective, of course, the Houthis in Yemen backed by Iran are a resistance group opposed to Israel, and it's the US that's destabilizing the region by sending military assets into the region in support of Israel. But you mentioned the incident between the US and the Houthis just the other day. I don't think it's a coincidence that this is happening now. I think it's a message from Iran to the US, which is upping its presence in the region, a message of deterrence for them, and a message also to global shipping and shipping companies that the current tensions, the current diversions that are coming with them aren't going away anytime soon.
Okay, so we watch for those disruptions to continue. Interesting to see then that Iran echoes the language being used by the United States, of course, employing what it's called its Prosperity Guardian mission within that important shipping lane. So what is the significance of this move from Iran right now?
I think it's significant because the Red Sea is effectively becoming another front in the war between Israel and Hamas. Now, so far it's been a kind of proxy front with the Houthis backed by Iran on one side, targeting shipping interests in the region, and the US more recently trying to counter that with its allies. But Iran publicly announcing that it's sending its own, not a proxy force, but its own military assets into a front of this war is a first. And I think, unfortunately, for those looking for signs of de-escalation, this is one of the opposite.
Yeah, certainly not a sign of de-escalation. And how does it raise the stakes then, Patrick? I mean, this is such an important, from an economic perspective, even if just sticking with that, this is such an important shipping lane, isn't it? Some 12% of global commerce uses it.
Exactly. I mean, new military assets in the region. The stakes were already high. The tensions were already running high. We were having almost daily shipping incidents for a time just before Christmas, and we had that deadly incident just the other day. With new military assets being there, I think it just raises the chances of confrontation and raises the chances of miscalculation as well. We don't know exactly where each country's individual ships are, but with every new one you add to what's already a mixed picture, I think you're increasing the chance that something happens between them.
Patrick, thanks very much. Thanks for the update. Bloomberg's breaking news editor for the Middle East, Patrick Sykes, with a briefing on the latest news flow. Let's get to some of the other top stories that we're tracking on the Bloomberg terminal this morning. Israel's Supreme Court has overturned a highly contested law aimed at weakening the power of judges. The ruling is a setback for Prime Minister Benjamin Netanyahu's right-wing coalition. The court, sitting with all 15 justices for the first time ever, voted 8-7 to strike down a law passed by Parliament last summer that would have barred judges from voiding government decisions. Japan's public broadcaster NHK says at least 48 people are dead after the powerful New Year's Day earthquake off the Noto Peninsula. All tsunami warnings have been lifted, though dozens of aftershocks are still rattling the region. More than 30,000 homes have been left without power. Some areas also don't have running water. The US is cutting the number of electric vehicle models eligible for a $7,500 consumer tax credit as new rules kick in. The narrower criteria have slashed the number of qualifying models from around 24 to 13. The new rules exclude EVs that use battery components made by Chinese manufacturers. And staying with the auto sector, Chinese automaker BYD sold over 526,000 fully electric vehicles in the fourth quarter. That means Tesla will need a record showing to maintain its #1 status when it unveils its own sales figures later today. In total, BYD sold more than 3 million electric and hybrid vehicles in 2023. That's almost as many as in the previous 5 years combined. Carnival CEO Josh Weinstein says the cruise operator is already 2/3 booked for 2024. He told us that demand is coming from shifting consumer priorities rather than just post-pandemic revenge tourism.
2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending levels. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It could continue because you're such a great gauge of how customers are feeling. You just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. As a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating, it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year. And on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about 1/3 of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. Every quarter this year, people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. And as a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving, good morning, good to meet you. Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how would you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. Unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel, but to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, I mean, when we think about our business, we're a little bit different from when you're looking at hotel companies. I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations, and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
That was the Carnival CEO, Josh Weinstein, speaking with Bloomberg about travel demand. Coming up on the program, Saudi Arabia's PIF emerges as the world's most active sovereign investor of 2023. More on that story next. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Across the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets today. We are 44 minutes into our European trading day, and European equity markets doing okay this morning, up by more than 1% on some of them, as you see there. The Xetra DAX in Germany, of the major markets, getting the best of the gains, up by just over 1%. Now, Saudi Arabia's public investment fund was the world's most active sovereign investor last year, as Singapore's GIC and Temasek slashed spending. Data from consultancy Global SWF shows the PIF deployed more than $31 billion in 2023. In total, state-owned funds invested $125 billion last year, down by a fifth from the previous 12 months. Our Riyadh bureau chief, Matthew Martin, joins us now. He's been looking at the figures, where that leaves Saudi Arabia versus the rivals, and the broader stories behind them. Matthew, good morning. So a huge year for the PIF. What can we expect in 2024?
Good morning. Yeah, as you're saying, look, the last year we saw the PIF becoming very, very active, spending huge amounts whilst a lot of other sovereign funds were retreating. The PIF sort of came into 2023 with a strong tailwind of high oil prices in 2022. That helped to give it the firepower to be very, very active throughout 2023. I think as we look into 2024, we're going to continue to see the PIF being a very, very active fund, even though it doesn't have the sort of the support from high oil prices and budget surpluses that it had in the past. But you see that it has now set up a lot of these subsidiaries that are active in areas for everywhere from sort of aviation to e-gaming to electric car making, and so it's really starting to deploy, and it has the teams in place to be able to play a much more prominent role in global markets. And we see from the Saudi Crown Prince, the de facto ruler of the country, who is also the PIF chairman, he's in a very risk-on mood right now when it comes to investing. He's prepared to give the PIF the funding and the financial support that it needs to be able to go out there and fulfill his ambition of making it one of the world's biggest and most impactful investors. And I think that's definitely going to continue to be a big theme over the course of 2024 as we continue to see them plow into areas like sports investing and in technology and in the energy transition. These are all areas where we're going to see the PIF putting a lot of money into over the course of this year.
Yeah, certainly cutting a very visible figure when it comes to sports investment, Matthew. But away from what Saudi money is doing right now, and back to the geopolitics within the region, there's tension on multiple fronts in the Middle East. We've just been covering the way, rival Iran has been sending a warship to the Red Sea, for example. How is all of that tension affecting Saudi Arabia?
Well, this is all exactly the sort of thing that the Crown Prince doesn't want to see at the moment. He's been pushing very hard over the past 2 years to try and calm down the region, to try and reduce tensions. We've had the deal to restore relations and trade with Qatar, the rapprochement with Iran, talks about normalization with Israel. This was all part of a broad plan to try and lower the temperature in the region, to try and attract the foreign investment that he needs to achieve on his goals for economic diversification within the country. So all of this is exactly the sort of thing that he doesn't want to see. And as you're saying, the tensions in the region are only getting worse now with the Red Sea, this Iranian warship heading into the Red Sea now. That's got potentially risks further escalation. We've had the US a couple of days ago confronting some of the Houthis and destroying 3 of the small boats and killing around 10 Houthi fighters. So this is going to further inflame the region, and yeah, has the potential to have a big impact on Saudi in its attempt of trying to attract foreign investors into the country.
Matthew, thanks very much. Bloomberg's Rio Bureau Chief for Bloomberg, Matthew Martin, with the latest on the PIF and the geopolitical background. Let's jump from that to the European growth story, because we're just getting some manufacturing PMI data coming out from Italy. We had the numbers out of Spain earlier on. They ticked slightly downwards, but today's Italian number ticking in the right direction, moving a little closer to 50, but still very weak, still with a 45 handle, so 45.3. That's better than the prior reading of 44.4, better than the survey of 44.2, but as I say, still well below 50, so still in contraction territory for Italian manufacturing. Coming up on the programme, Treasuries priced for big Fed cuts face correction. That is the view from our Markets Live team as we kick off the new year. We'll get their 2024 outlook next. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
Our preference is still to find global conglomerates with exposure to China rather than investing directly into that Chinese equity market.
Based on what we see, our allocation is likely to go higher. It was higher this year than it was last year, and we think that will be the case next year as well. China is a good market for relative outperformance. It is also a good market for absolute performance, not just this year, but it has been for years, and we think it will continue to be that way.
So we expect more reserve rate cuts next year and some more policy easing, but not bazooka-style stimulus. Right now, China equity market is priced for a slowdown, growth below 5%, so expectations are low, positioning is very low. So we would be gradual buyers as the property market bottoms into next year.
China has got some good ideas, but the visibility is missing, and as a result, a lot of investors don't want to stay, don't want to commit to China on a longer-term basis, preferring kind of shorter-term trades, tactical trades.
So some of our guests there on the outlook for Chinese markets this year. Let's talk about the broader market outlook story and join Venram, who is with us from the Markets Live team. Happy New Year to you, Ven. Thanks so much for joining us. Let's pick up where we left off with conversations about treasuries, shall we? And Ven, do you think that markets are then getting ahead of themselves a little bit as we look out to 2024? Are market participants expecting a little too much in the way of Fed rate cuts this year?
Morning, Anna. I do definitely think that treasuries are expecting a bit too much and a bit too soon. I think that's the key point with the way treasuries are priced, especially the front end. If you look at the 2-year yield, we are now around 425, 430. And that is kind of messaging to the investors in the markets that, look, we should expect the Fed to cut rates imminently. We have moved some 80 basis points in terms of the 2-year yield in the past 2 months. That kind of reminds me of what happened in early 2020 during the pandemic when we saw a move of similar velocity. Of course, then the Fed came out and cut rates by 150 basis points in the month of March 2020. But that's not going to happen now simply because the economy is doing just pretty well. So I think there is the front-end treasuries are due for a correction from here.
But does it make sense given that we're fading inflation expectations quite rapidly, Ven?
Yeah, I think that, that's the other part of the equation. The markets are thinking that if you look at the break-even curve, we are pretty flat on the curve, and we are priced for 2% inflation for the foreseeable future. I don't think we get to 2% inflation anytime soon. Yes, we have seen a pretty strong disinflationary narrative, but that's not equivalent to a 2% PCE inflation. And the Fed themselves have reminded us that we are not going to see that before 2025. So I think that the markets are a bit too over-exuberant here.
And where does that leave the dollar then, Ven? We've talked a lot as we pivot towards a situation where the US, where the Fed is expected to cut interest rates. We've perhaps front-run that quite a bit when it comes to FX markets. So how much dollar weakness is there still to play for here?
I think there is quite a lot of dollar weakness to come and that's independent to some degree of the Fed, because if you look at real rates in the US, they've crumbled a whole lot. And that is going to continue because of the disinflationary narrative that we have seen. And if that continues, and if the Bank of Japan normalizes policy, and I think that there will be less room for the Bank of England to cut rates. And if you put all that together, what you get is one of non-strengthened non-dollar non-G10 currencies, non-dollar G10 currencies, beg your pardon. That's what we see for 2024.
Okay, so you're at least the second person, perhaps even the third person this morning, Ven, to say that markets shouldn't expect the Bank of England to cut as much as the others. And in fact, markets don't expect the BOE, I think, to cut as much as the others. What explains that briefly, Ven?
Well, I mean, if you look at services inflation, we are still hovering above 6%. And the BOE's Catherine Mann and Governor Andrew Bailey told power lawmakers last month that, look, we are not going to see headline inflation crumble to 2% unless we get services inflation down to 3% or thereabouts. That's a long, long way to go from here. So I don't think that's going to happen anytime soon. And therefore, the BOE is not going to be in a hurry to cut rates.
Ven, thanks so much for your time. Venram joining us there from the Markets Live team. Remember, you can get up-to-date analysis and insight from Ven and Mark and the rest of the Markets Live writers. So go to MLIV Go on the Bloomberg terminal to find out more. Just to say, we've got the French and the German manufacturing PMI numbers, but they were final readings. They came in broadly as had been anticipated. A 42 handle on France, a 43 handle on Germany, so kind of as you were on the contraction in manufacturing there. That is it for this hour. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Maersk saying it's holding off resuming shipments through the Red Sea and oil off the back of it gaining as Iran sends a warship to the area. It all comes after the U.S. Navy destroyed 3 Houthi boats. And now at least 48 people now confirmed killed after an earthquake in Japan as fresh aftershocks continue to rattle the region. Plus, a Bloomberg scoop reveals ASML canceled some shipments of high-end chip-making equipment to China, all after pressure from the U.S. government, but before the sanctions took full effect. Let's get a quick look at the European markets map as, of course, investors digest what's going on in the first trading day of the year. It's pretty straightforward. Green on the screen is what you're going to see. But look, futures had already set us up for those kinds of gains. What's important to keep in mind, though, is that you are seeing some outperformance in some of the main indices. But again, it is still very light trading volume. No major positioning just yet. But it does speak to the idea that perhaps we are starting the year off on a good note. Remember, however, though, that January is tentatively seasonally a pullback year, just given year on year. Last year was a pretty big one, not just for the U.S. indices, but for the European ones as well. So again, waiting for more of that trading volume to kick in to see if that seasonality actually has an effect going into, of course, the first month of 2024. It all comes as we also digest the geopolitics in the Middle East as well, and what that means for the investor playbook. Iran has now sent a warship to the Red Sea after the U.S. Navy destroyed 3 Houthi boats over the weekend. The move risks ratcheting up tensions and complicates Washington's goal of securing a waterway that is vital to global trade. At the same time, Maersk, one of the major shipping lines, saying it's holding off on resuming routes through the area after a weekend attack on one of its vessels. There's a lot to digest there. Let's dive into it. We're joined now by Bloomberg's Sam Dagger, who's, of course, been covering the story very, very closely. Sam, a pleasure to have you on the program. Give us the latest from the Red Sea.
Sure, my pleasure. So we had Iran yesterday send this warship to the Red Sea in a show of force and support for the Houthis, whom it's been backing for almost a decade now. And it actually happened while a senior official in the Houthi movement was in Tehran. He's still there, as far as we know, meeting with some of the most senior figures in Iran's government. So it's a clear show of support. And plus, we had the Iranian foreign minister come out and say yesterday that Iran was supporting, the choices that the Houthis were making and effectively rejecting, calls by the West on Iran to rein in the Houthis. So really this adds to an already very tense and volatile situation in the Red Sea. You've got the U.S. there leading this multinational maritime force with 10 countries right now, at least the ones that publicly announced, including the U.S. and others who've said they would join. Denmark. I mean, it's worth noting that after the attack on the Denmark-owned ship, the Danish foreign minister told us in remarks emailed to Bloomberg that that Denmark was even more determined now to send a frigate to the Red Sea to join that coalition, because he said, what was happening was a huge danger for global trade.
It's interesting you're talking about the Danish response. Even the Greek response has been pretty crucial because historically they've been two major shipping powerhouses. Sam, Bloomberg Economics said that when it comes to actual global trade disruption, when it comes into real translation into GDP numbers, for example, it would still take a sustained level of tension, months even, years even, to really see that show through. We're already a couple weeks into this conflict in the Red Sea. How much has global trade actually been disrupted?
I think it's hard to assess, but certainly, I mean, the longer this goes on, the more it's going to have an impact. I mean, remember, this is a waterway. We're talking about, the Suez Canal in the north of the Red Sea and the Bab el-Mandeb Strait, which leads on to the Gulf of Aden and the Arabian Sea and onward to the Indian Ocean. I mean, this is a waterway that accounts for anywhere between 10 and 15% of global trade. I mean, all the commerce between the Far East and Europe. I mean, most of Europe's energy needs, at least through the fuel tankers coming from the Middle East, have to transit the Red Sea. So this is huge.
I mean, it's certainly something that's already showing up in the market moves. You're seeing it on your screen right now. Some of the major stock market moves that we've seen off the back of some of the tensions that you just pointed out. Bloomberg Sam Dagger there walking us through the crucial stories we need to know out of the Red Sea. And as he speaks, we're seeing Maersk higher by 3.7% in the European trading. A really strong start to some of these shipping margins that, of course, will then feed into their bottom line profits. But the question is how long, when you're adding voyages that are 40% longer in distance, when you're adding more labor, more fuel, and that's going to be the question in terms of just how long this can sustain. Of course, the crucial story is how long do we start to see the conflict between Israel and Hamas really extend? And it brings us to a crucial story because it's not just an international one or a geopolitical story. It's certainly a domestic one as well. That's where I want to go next. Israel's Supreme Court has overturned a highly contested law aimed at weakening the power of judges. It's a ruling that's a setback for Prime Minister Benjamin Netanyahu's right-wing coalition. But it's a little bit of a complicated story. Let's get a little bit more analysis here. Bloomberg's Alyssa Ottenheimer joining us this morning. Alyssa, thank you for having us on the show. Talk to us a little bit about what the government was originally aiming to do.
Hi, Kriti. Thanks so much for inviting me. Well, it all began about a year ago. You have to understand that this government is quite right-wing in comparison to previous governments. And the Justice Minister announced that they're going to take the opportunity to make a big judicial overhaul, because what the government felt was that even though they have the votes to rule the country, because the Supreme Court is able to review and to strike down some of the moves that it makes, that it really isn't able to do what it wants to do. So, for example, in January, Netanyahu appointed a minister, and the Supreme Court ruled that even though there's no law against it, it wasn't reasonable. So the government decided that it would change one of the basic laws concerning the judiciary, and ruled that the courts could no longer no longer use this reasonableness as a test of whether a government policy was okay or not.
But talk to us a little bit about the reaction now of the Supreme Court turnaround. And to your point, this has been something a lot of the international community has said, this is kind of where Benjamin Netanyahu is crossing the line. Do you think this is enough, perhaps, to change that public opinion?
Yeah. So as you mentioned, the government law that was enacted in July had spurred all kinds of demonstrations, hundreds of thousands of people demonstrating week after week against it. Mainly led by the left wing. Now, Israel's quite split down the middle between right and left wing, and the left wing protested against it quite a bit because they felt that it would give the government too much power. Now, what has happened now is that the ruling was given now because two of the justices are going to be retiring, and there's a rule that that they must turn in all their rulings before 3 months has passed. So that's why they gave it. That's why they handed down the decision now. What's ironic is that the drama has been somewhat been reduced because really the whole country is no longer focused on the judicial oversight law, but is really focused on the war with Hamas. So the government's reaction was, number one, why did you hand this down in the middle of a war? We want to try to keep the country united, and this is an issue that has divided the country. And why are we bringing it up again? But number two, the whole drama of the decision, I think, has been somewhat reduced, and it doesn't seem that that the government will try to do anything about it. In other words, will try to enact another law because there's a war going on, and that's a lot more important.
It's certainly something that is creating a lot of mixed currents from someone viewing the conflict and the internal turmoil from the outside. Bloomberg's Alyssa Ottenheimer, we thank you so much for bringing us that crucial context on something that could really change the trajectory of Prime Minister Benjamin Netanyahu as she laid out. Of course, that's going to be a story that we watch very, very closely, but let me bring you a couple of other ones as well. Starting in Asia, Japan's public broadcaster NHK says at least 48 people are dead after the powerful New Year's Day earthquake off the Noto Peninsula. All tsunami warnings have been lifted, though dozens of aftershocks are still rattling the region. And more than 30,000 homes have been left without power, but some areas still don't have running water. Meanwhile, in South Korea, the main opposition party leader Lee Jae-myung has been attacked during a visit to the southern coastal city of Busan. The Democratic Party's nominee for the presidential election in 2022 was taken to hospital with bleeding from his neck. Video of the incident appears to show Lee walking through a crowd of reporters when the attack happened. Now, much more to come. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to The Pulse. I'm Kriti Gupta in London. Well, look, the consensus call for 2024 is that bonds are back. The bull market we've seen for the last 40 years or so, well, it's going to sustain. At least that seems to be the trend lines you see on the major chart. But the question is, for how long and with what kind of momentum behind it? Who better to ask those questions than Ian Steely, International Fixed Income's CIO from JP Morgan Asset Management, joining us this morning. All right, well, if bonds are back, let's start with the numbers here. What is the floor in yields for the 10-year?
So if you think about just the surprise that we've had over the last few months and ending the year, pretty much where we started 2023, but it is different this time around because the central banks have let the cat out of the bag that I think they want to be easing policy from where they are. They do feel that they're in restricted territory and inflation is coming down. And I wouldn't be surprised if we do go towards 3.5 in the 10-year, first half of this year, and then possibly even lower in the second half. But it will depend on the data. It will depend on inflation continuing to do what the central banks believe it will do. And then we could go even further if we see weakness in the jobs market.
And how do the rate cuts price into that? We're looking at 5 rate cuts priced into the market right now. The consensus among economists is that the markets are way too ahead of themselves. What would be the surprise rate cut call for you?
The surprise rate cut call would be that they actually end up doing more. And if you go back through history and take out the last cutting cycle, because obviously they only managed to get rates up to a certain level, but previous cutting cycles, typically the Federal Reserve's managed 250, 260 basis points in the first year. So you could argue that 150 that's priced at the moment is actually not a lot. Now, in those scenarios, you've obviously had a deep downturn, and they've had to react, and most people are expecting a soft landing and these sort of proactive cuts. But the risk is that they could end up doing more.
But if that risk is then ending up becoming basically a tailwind for the bond market, I'm curious what reverses it. I mean, it feels like the no-brainer is obviously if the inflation data goes in the wrong direction, but what might drive that?
I think if you continue to see resilience. So the big surprise last year was the strength of the consumer and how well that held up and how the jobs market didn't deteriorate, and the fact that we'd had these 525 basis points of hikes from the Fed and pretty much every other central bank around the world, and we hadn't really seen it hit the broader economy. And if that continues this year, and that the Fed start cutting and we continue to see the jobs market do well and inflation doesn't fall to where they want it to and maybe starts to re-accelerate, that's the big concern. And if you think back to Q3 of last year, that's what we were discussing then. Now that feels like it maybe was a bit of a blip, but if we reappear to that sort of scenario, that's going to be a concern for the bond market and concern for the central banks.
Well, Q3 of last year was traumatizing for a lot of bond traders simply because of the sell-off on the long end of the curve. But it brought about this question about how much volatility can the market really stand, given that it almost feels like the market is in control of rates, perhaps more so, or one would argue more so than the Federal Reserve, just given how much money is parked in on the front end of the curve. If we're talking about this built-in tailwind for the bond market, I'm curious about the volatility there. Do you see that easing in 2024?
I think the volatility does ease if you take away the fear factor for the markets, which is further hikes, further tightening from the central banks. If you get into the market gets into a mindset where the central banks are done and the next move is towards cuts, which is where we feels like we are at the moment, the reality is the volatility should come down. Now, I don't think it's ever going to come down to the levels that we saw post-financial crisis, pre-pandemic, when rates were at zero and we were doing QE and really flooding the market with liquidity. But we should see probably a little bit lower volatility than we saw last year.
But in terms of going into the presidential election and the fiscal deficit debates that we're going to be seeing in the United States, specifically that kind of rear its ugly head in January of 2025, so right when we get the results of the election, how do you price something like that into a bond market?
I think it's quite difficult, and it's probably likely to be more a second half of this year type pricing. I think the first half of this year will be more focused on whether the Fed is able to follow through on what the market's pricing from a cutting standpoint. But we have to remember there's a lot of supply coming this month across the globe, not just the US, but also within Europe. We saw this big rally in the bond market. So maybe bond yields have moved a little bit too low just in the near term. But for me, that might be a tactical trade. The more strategic opportunity is that actually the yields that you're getting on offer now within the bond market, if the central banks are done, if they're going to be cutting, later this year are looking attractive, and you should be looking to get invested in it.
Do we need to be worried about the plumbing, though, to make that happen when we're talking about how much supply is actually going to hit the market, how much supply is going to be digested by the market, given that the Treasury is still auctioning a pretty substantial amount of debt?
But again, if you think back to where we were, that was the big fear in Q3, and then obviously Q4, when people want bonds, supply gets taken down. And if you look at where the amount of money that's sitting in cash funds today, and if you can't guarantee that you're going to continue to lock in those cash yields, and the concern is that you're going to be lower yields because of central bank easing, you want to be in the bond market, that should see money flow into bond funds, and then ultimately there's where your demand is.
But at some point, that has to reverse, right? I mean, you're having major longer-term conversations, to be fair, from some of the major even investment funds around the world, some of the major countries around the world that have been longtime holders of treasuries. Wasn't this part of the fear of the sell-off that we saw on the long end of Q3, that people don't want exposure to American debt? It certainly didn't help when you had Moody's basically issuing a warning about the deficit issues. I'm curious about why that was maybe brushed off in Q4.
The brush off was the data helped. Some of the supply announcements were more favourable, maybe not as much supply issues as people had feared. And then, say, lower yields. And if yields are going to be low and you'll be able to gain capital on your bonds, people want to get reinvested in them. And I think that's what we're going to see. I still think there's a lot of demand out there for bonds. I still think people, on average, are sort of underweight bonds. And a number of client conversations that I had last year was people weren't willing to go into the bond market until they had more conviction the central banks are done. Well, hopefully that's the case now, so they can take that leap of faith and go into the bond space. So I do feel there's going to be that demand. But what it probably means, to your point, is yields just don't go back to where they've been in the last decade. We're not going to go back to 1%, but we can go a little bit lower than we are today.
All right, so not 1%, but lower than 3.94 is where we're at right now. And I think you said at 3.5 in the first half of 2024. Ian Steely, we have to leave it there. He's answered the rapid fire round of the bond market that I just gave him. International Fixed Income CIO from JP Morgan Asset Management there. We thank you as always. Look, there's a lot coming up, and we're going to go right back to the geopolitics of it all because those stories are developing. Bloomberg learning that ASML has now canceled shipment of some of its machines to China ahead of the export bans. We're going to bring you the details next. Stick with us. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
This
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg has learned that ASML canceled shipments of some of its top-of-the-line chip-making machines to China at the request of the United States before expert bans had actually come into effect. It's a crucial story, an ongoing one for the world's largest chip maker, or chip equipment maker, I should say. Bloomberg's Sarah Jacobs is in Amsterdam to bring us the story. Sarah, why did ASML do that?
Hi, good morning. So Europe's largest tech company, ASML, canceled shipments of some of its machines to China at the request of U.S. President Joe Biden's administration. That's what our sources are telling us. So U.S. National Security Advisor Jake Sullivan, we are told, called the Dutch government late last year and spoke to them about this matter. And Dutch officials, asked the U.S. to directly speak with ASML regarding the shipment of the machines. And the machines are called immersion deep ultraviolet lithography machines. So that resulted in the Dutch government then partially revoking licenses recently for some of these certain advanced machines to China, and that affected a small number of customers there.
And of course, we know it puts the Netherlands in the middle of two of the largest economies in the world. Geopolitical tensions that we know have been going on for, well, years, really. But of course, in the last, I think, 2 months or so have kind of sustained. We'll see where Netherlands falls into that with, to your point, the largest tech company in Europe. Bloomberg, Sarah Jacobs in Amsterdam, we thank you so much for your reporting this morning. And coming up, we stick with the emerging market story. Remember, the de-dollarization story, still extremely important when it comes to what the trade is in 2024. Well, it looks like the BRICS Club is now going to be doubling its membership. More what that means for global geopolitics, for trade, for the dollar, all of that analysis and more coming up with a true expert on not only the current BRICS members, but the new ones coming up in the block. We're going to dive into really, again, the geopolitics, the trade, the markets. This is the story that matters for 2024. Stick with us. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
This is Bloomberg.
Maersk says it's holding off resuming shipments through the Red Sea as oil gains amid Iran sending a warship to the area. It all comes after the U.S. Navy destroyed 3 Houthi boats. And at least 48 people now confirmed killed after an earthquake in Japan. Fresh aftershocks still rattling the region. And a Bloomberg scoop reveals that ASML canceled some shipments of high-end chip-making equipment to China after pressure from the American government. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. A lot to digest there, but we are getting some headlines breaking, this time coming out of Japan. It looks like a JAL, Japanese Airlines aircraft, has now collided with another plane after landing. That's, of course, according to the NHK, their national public broadcaster there. It looks like passengers were on board when the accident has occurred. You are looking at live images from Tokyo, of course, of the fire being put out. As we get more information, we, of course, will bring them to you. But for now, these live images and the headlines that we're getting coming from the national public broadcaster NHK live out of Tokyo, where it is about 6:30 p.m. local time at the moment. Of course, the fire also seen largely from the airport. Unclear whether or not there are any fatalities or injuries. We, of course, will keep you apprised as we know. I want to move on to one of our top stories here. Ukraine says it shot down almost 90 Russian drones on New Year's Eve as the war grinds towards its third year. It followed Russian missile attacks over the weekend that killed at least 30 people in Ukraine. Joining us for more on this, Bloomberg's Piotr Skolimowski all over the story. Piotr, it's a very dim, it's a very tragic anniversary that we're headed to. Walk us through the state of play.
Yes, so we had a fresh attack today, actually. There was a missile attack coming from Russia again. And around more than 20 people are wounded. The attack mostly affected Kiev, but also was targeted at Kharkiv. So the big cities are again being targeted. What we're seeing over the last few days, actually over the last week or so, is that there's an intensification in terms of the air warfare. We've been hearing so much about the fact that in terms of the ground offensive, things have basically ground to a halt. We heard so much about the stalemate. Meanwhile, what we're seeing right now is that in terms of aerial warfare, this has really intensified. And it started with, actually last week, with Ukraine allegedly destroying a landing ship that Russia had in Crimea. And since then, things have really gone into tit for tat. Ukraine, again, hitting Russia's town, or at least Russia claims it hit its town Belgorod on the border with Ukraine just a few days ago. There was a massive strike just before the new year, affecting a lot of residential areas across the country in Ukraine. And obviously, we heard yesterday from President Vladimir Putin, who said the attack on Belgorod amounted to a terror attack, and he pledged that he will attack, and there will be more attacks from Russia, and they are indeed coming today. Obviously, we have to remember that Putin is facing election in March. It's not And he has to project this idea that he is in charge. And the fact that we're having so much activity in the air suggests that he's going to intensify attacks, especially that Ukraine seems to be a bit on the back foot, in fact, because of the fact that Western aid is blocked, or some of it is blocked. So the country is calling on its allies to provide more aid in terms of financing, in terms of weaponry.
Again, a very dire and tragic situation you are seeing in Ukraine, a lot of which the future depends on some of the aid you are getting out of the U.S. and Europe as well, where at a time the politics really just not working in that favor in both regions. Piotr Skolimowski, we have to leave it there. He's our Bloomberg Warsaw bureau chief, bringing us that live reporting. And look, as a piece of the conflict you're seeing in Ukraine and now in Israel as well, from an investor standpoint, there's a lot of concern about how much exposure you want to the conflict, especially those specific regions, which have now, by the way, become a part of the BRICS group. That is the latest developments coming out of the Middle East. Membership of the BRICS group of emerging market nations doubling. Saudi Arabia, the UAE, Iran, Egypt, Ethiopia, all officially joining the group. On the other hand, Argentina declined an invitation for membership. Now, the expanded bloc pairs some of the world's largest energy producers with, by the way, the exposure to those tensions with some of the biggest consumers among developing countries. I'm joined now by Pallavi Roy, an associate professor in political economy at SOAS University of London. She, of course, joins us from Calcutta, India this morning. Pallavi, a pleasure to have you on the program. Thank you so much for joining us, and Happy New Year to you. Let's start with the significance of this move. Talk to us about in the context of de-dollarization. Argentina's Javier Milei has been very vocal about de-dollarization, and yet not really touching this particular partnership. Where do the newest members of the BRICS group stand on that?
Well, that's an interesting question that you begin with. Argentina's new president has certainly been very vocal about de-dollarization, but what's also important is diplomatically, he has been very clear to signal that he is not as anti-Western as the BRICS compact actually is really trying to project with this expansion. So even though he has been talking about de-dollarization, it will be on his terms, whereas the BRICS, it's not just looked upon in terms of the economic aspect of it, which is the de-dollarization aspect of it. Much of it is actually the geostrategic signaling that the BRICS group actually now wants to inform the high-income, Western bloc about. This is the BRICS grouping is really essentially something that's far more geostrategic than just about the economy or about de-dollarization. So to me, this is much more informing the Western bloc, the high-income Western bloc, if you so wish, that we can take in the kind of members, for instance, Iran, for instance. I think this is a really excellent signaling mechanism which says, you might shun, but we are prepared to take on board, members of the international community and countries that you will not do business with. So to that extent, de-dollarization is not front and center, but the BRICS countries, and certainly even in some members of the BRICS Plus, have been talking about looking at an alternative to the dollar. And what's interesting is you did bring up this idea of a large number of consumers in the BRICS Plus countries. But if you look at it, with this new accession with UAE, with Saudi Arabia, with Brazil, with Russia right now, what you actually have is the grouping will enjoy about 43% of the world's oil production, up from 20%. And this is where things could get really interesting. The choice of countries really seems to represent an energy compact, and that allows them to be less vulnerable to risks in oil trading, allows them to trade in their own currencies rather than, I'd say, directly about de-dollarization. So that's an important point to pick up. You could trade in rubles, you could trade in yuan. It actually becomes easier to trade in Iranian oil, and this could be a sticking point for the West. So to me, it's a lot more about the geostrategic signaling than just about primarily de-dollarization.
Pallavi, you bring up an excellent point because you've already actually seen that dynamic, especially in terms of oil flows between the likes of Russia and China or Russia and India, for example, where you have seen those alternative agreements actually taking place. But I'm curious about what kind of precedent that sets then for other kind of commodity trades. I mean, South America in particular, a lot of these BRICS countries, India, Brazil even, are known for their agricultural exports. So this dynamic you're seeing in oil, does it extend or expand to other commodities?
that is a wait and watch. There's a lot of iron ore also, for instance, between, there used to be a lot of China imports to China from India for iron ore. Brazil, a big iron ore exporter. China, a huge iron ore consumer. And the Indians are trying to get their iron ore trading in order recently. So certainly this could at some point be extended to other commodities. But I would think that this is much more about the energy compact with oil diplomacy actually becoming a big part here. In terms of whether these currencies, and the other aspect also is whether these can be globally traded currencies. But apart from China in the BRICS and the BRICS Plus grouping, there really isn't any other country that accounts for more than, let's say, 3 to 4% of world trade. Even India, which is one of the largest economies in the BRICS Plus grouping, accounts for about less than 3% of world trade. So that to that extent, it will be displacing the dollar, perhaps in the trading that happens within these countries. But whether it displaces the dollar completely, I think that's really still very far off. And also do think about the fact that all these countries, without exception, do not have what we call a full capital account convertibility. And unless that happens, it's going to be very difficult for them to displace the dollar and then become fully convertible and tradable to replace the dollar. So to that extent, no, it's not going to happen.
Getting very, very nerdy very quickly. I love it. A final question to you. I want to, in our last minute, ask you about the response that some of these developed economies are getting. It's not just an American story, it's even a European one. In our last minute here, what does that look like?
Sorry, could you repeat the question? I have a slightly dodgy broadband connection here.
No worries, no worries. Happy to. What is the response then from the developed economies, from the United States, from Europe, in the face of this really growing partnership you're seeing in the EM world?
I definitely think that the Western Bloc cannot ignore the BRICS and the BRICS Plus grouping. Like I said, it's much more a geostrategic grouping. These are influential economies. It might seem on the face of it that China is the biggest elephant in the room, but the others are actually increasingly becoming middle-income powers. There's India, there's Brazil. There's Saudi Arabia, which has been really flexing its muscles now and trying to strike out very independently as a country that's not really part of the American Defense Compact anymore, increasing relations with China and Russia. I think the West, before the entrance of Iran, had been strategically welcoming of the bloc as a kind of balancing act. But the entry of Iran is going to make things a little awkward for the Western powers. But then again, if you look at where the Western powers stand, especially with the IMF, with the World Bank, in terms of being a sort of financing powerhouse, there is still very little, certainly in the short to medium term, to replace that heft that the West has with the kind of financing that the BRICS Plus and the BRICS grouping actually also thinks of having. So the West will not want to ignore it. Indeed, it should not ignore it. But whether it sees a real and present danger in the immediate short to medium term, I doubt that the West will be very worried. But it's one to watch out for sure.
Right. Yeah, not to mention the internal dynamics within the Middle East as well. Think of Saudi versus Iran or Iran versus Egypt and how that all plays out. A fascinating topic we can go talk about for hours, but Pallavi Roy, we have to leave it there. We thank you so much for joining us. She joins us from the SOAS University of London, but of course this morning from India this morning. I want to bring you a quick update on some of the headlines we're getting out of Japan. At the start of the segment, talked about a Japanese airline plane with a few hundred passengers. It looks like about 400 passengers and crew were on board the plane. Had collided with another plane as well at Haneda Airport in Tokyo. This all coming from NHK, the national broadcaster there. It now looks like all passengers and crew on board were evacuated, but you are looking at live images of a fire that still has yet to be put out, and we still, of course, don't know the real cause of the collision and the full extent of the damages. As we do, we will bring you those headlines right here on Bloomberg. Plenty more to come for the geopolitics and the markets. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Saudi Arabia's public investment fund was the world's most active sovereign investor last year, as Singapore's GIC and Temasek slashed its spending. Data from consultancy Global SWF shows that the PIF deployed more than $31 billion in 2023. In total, state-owned funds invested $125 billion last year, down by about 20% from the previous 12 months. Our Riyadh Bureau Chief Matthew Martin joins us now. He's been all over this story. Matthew, do you continue to see this momentum in 2024, or is this all in the rearview mirror when it comes to the PIF?
Yeah, I think, look, absolutely. I think we're going to continue to see the PIF being very, very active, both internationally and domestically in 2024. Last year, I think it was very much sort of, following in the tailwind it had from high oil prices in 2022, which enabled the government to give the PIF more firepower to go out and invest. This year, I think, there's a sense that we might see the theme shifting towards domestic investments as the PIF looks to sort of help execute on a lot of the diversification and investment projects to diversify the Saudi economy away from oil. But that being said, I think, the Crown Prince Mohammed bin Salman has shown that he has a pretty high risk appetite and is prepared to make very big investments, prepared to give the PIF a lot of capital to go out into international markets, so that the PIF and Saudi Arabia more broadly become viewed as this real investment powerhouse and a real key player in terms of international capital markets. And that's where he wants to see the PIF positioned. So I think even if we do see a shift towards more domestic investments, we'll still see the PIF play a big role internationally as well.
But does that change when you look at some of the geopolitical tensions as well when it comes to investor exposure to not just Saudi Arabia, but the broader region? Is that an issue?
Yeah, I think, the political tensions that we have in the region right now are clearly going to be weighing on big global investors as they look at the region, and as Saudi Arabia increasingly tries to capture a bigger slice of any investment coming into the region. The fact that, it's a region that looks increasingly unstable. It's a region that looks, increasingly sort of at the center of a lot of these sort of problems going on in the world. We've got, the Red Sea tensions ratcheting up there, the continued Israel-Hamas war, Iran continuing with its nuclear weapons, nuclear program, and, the skepticism about whether this is going to lead to Iran developing a nuclear weapon. This is all going to be weighing on big global investors as they make decisions to put money into the region.
A truly intense time, I have to say, for the Middle East, especially in the context of some of the geopolitical conflict that we are seeing, but also at a time when the Middle East is growing incredibly quickly, as shown by the PIF's pretty substantial gains in 2023. Bloomberg's Riyadh Bureau Chief Matthew Martin, we thank you so much for bringing us that crucial story. And we, of course, go from Saudi Arabia to the natural pivot, which is space, and specifically space in the UK. The UK is struggling for liftoff in its dream to become a space superpower. It's all as political disarray and weak funding undermines the country's industrial strategy. In 2023, Britain's top satellite powerhouses, Inmarsat and OneWeb, were absorbed by overseas rivals. It's a crucial story, again, in the context of the geopolitics and the wars that we are seeing around the world. Bloomberg's Thomas Seal is all over that story. Tom, the space race continues, apparently, 40, 50 years later than the original one. Why is the UK trying to become a space superpower now?
Yeah, it's a great question. It's really a new space race after the 60s and Sputnik and Neil Armstrong, and it's driven by this increasing commercialization of space, cheaper electronics, much cheaper launches, and there's one man who's really driven that more than anyone else, which is Elon Musk. His company, SpaceX, the satellite part of that, Starlink, has redrawn the satellite industry. SpaceX's rockets have totally changed the economics of launch, and everyone's trying to get in on that. At the same time, we see with the war in Ukraine, it's become very strategic to own some of these assets and to control some of these assets that allow new kinds of communications that can't be disrupted as easily. And, we see the Ukrainian military relying on Musk's Starlink. So Britain saw that, and it's trying to get in on the race, but its success, I'd say, a few years into this, is mixed as the piece goes into.
And, of course, there's a lot of concern then about what it is like for a private owner like Elon Musk to be owning technology that could be changing the course of massive wars that, again, reshape the entire conflict. It's not just about, of course, rocket ships, for lack of a better term. Talk to us about some of the challenges there, though. I mean, the UK, it feels like, is trying to put their hands in a little bit of everything, trying to gain some sort of edge. Give it 10 years, for example. Do you think they can actually make a dent?
Yeah, to be fair, my piece, I don't want to be judging things too early. It's a long race. I think the UK has a seat at the table where it didn't necessarily, that wasn't guaranteed. It bought out of bankruptcy in a very surprising move during the pandemic, this company OneWeb, which is really the only active constellation of low Earth orbit satellites to rival Elon Musk's Starlink at the moment. That's now been absorbed by a French company, and so the UK has a smaller stake in that. And so there's a bit of tension with the European Union about how that's going to be used going forwards. And then on the launch front, about a year ago, the UK had a much vaunted plane launch of satellites, which failed. And that was Virgin Orbit, Richard Branson's company, and that then filed for bankruptcy. So, that was unfortunate and did not help the sort of the public image.
Yeah, it's a really fascinating story. And again, as we know that Rishi Sunak and some of his peers have been trying to attract that tech investment, I imagine defense goes hand in hand, as does, of course, the space program. Bloomberg's Tom Seal joining us for the crucial update. Look, it really extends to a variety of different sectors, and that's going to be something we're monitoring in 2024, alongside some of what Wall Street is actually expecting. We're going to bring you the analysis next. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue. Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
In 2023, some of Wall Street's biggest names getting it wrong with their predictions for how the markets would perform. Are they going to do any better in 2024? Well, Bloomberg has compiled more than 650 calls from strategists in today's Big Take. Our senior markets editor, Sam Potter, joins us now with more. Dare I say he's memorized all of them? I won't question him on it, don't worry. But Sam, talk to us a little bit about perhaps the call that most people might get wrong. What's the contrarian call that stood out to you?
Well, the interesting thing this year has been this sort of broad consensus for a mild slowdown, interest rates finally starting to bite, and then central banks pivoting to rate cuts. So I would say that the outlier calls, the ones that stand out are really the extreme bears. There's more bearish outliers than there are bullish, which I think underlines the downside risks this year with the US election, with the state of geopolitics. So someone like Robeco, the Dutch quant outfit, really stands out to me. They described the consensus for a soft landing as being a fairy tale, and Deutsche Bank also prepping for a hard US landing.
You know, it's a really fascinating story and one that I wish we had more time to deal with. Bloomberg Sam Potter, I'm sorry we have to leave it there. I'm putting you completely on the spot in terms of the contrarian calls, but he said it right there. A lot of the concerns are going to be around basically the soft landing or the hard landing. It's the big debate. Some might even throw in the fact that there's no landing at all. What does that even look like when you price in the markets when over and over again people keep saying that the biggest risk, the biggest inflationary risk, we just had Ian Steely over at JP Morgan join us this morning saying the biggest risk is that consumer resilience. Do we see more of that going into 2024? At least that seems to be some people's bear case. Up next, I'm sure it's going to be largely discussed. Bloomberg Brief with Danny Berger in London and Manus Craney in New York. They're going to set you up for the U.S. trading day on this first day of the year. Happy New Year, by the way, from myself and from the team. Plenty more ahead. Stick with us. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Will the ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
And was going to keep Green World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Mounting Red Sea tensions. Oil prices rise after Iran sends a warship to the region in response to the U.S. Navy sinking of 3 Houthi boats. Over in China, weak economic data keeps investors cautious on Chinese stocks as they post their worst start to the year since 2019. And ASML canceled shipments to China on the request of the Biden administration just weeks before the export ban was set to take effect. More on that Bloomberg scoop this morning. A very warm welcome. Happy New Year. What will 2024 bring us in terms of risk? There was a furious ferocity to the bond rally in the last 2 months of 2023. We managed to see yields drop by 100 basis points. We're reflecting this morning about what is your risk for 2024. Is it that core CPI ticks higher and perchance this central bank is not able to deliver what the market is paying for 150 basis points of cuts? I can tell you this, the specs, the net short by the speculative traders out there, 805,000. That is the biggest on record in a decade. Now that goes completely opposite to where the asset managers are. Just take your mind back. You were at 5% at the beginning of October, 390. The Treasury Index managed to whip it around and to deliver a 4% return at the end of 2023. What can it do in 2024? It must reassess the pivot, reassess the inflation, and perhaps reassess the scale and velocity of rate cuts. Crude is pipping higher this morning, up by over 2%. Of course, what we've got here is an Iranian warship now in the Red Sea. AP Moller-Maersk, they're out. They are not navigating anymore. And Rita Sen was with me at the end of last week. She sees $85, including war premium and a draw, coming to play in the crude market. Iron ore is up, even though the data, the official data on the PMI shows contraction at a manufacturing level. You have the Caixin, which shows a little bit more of an expansion. But when it comes to China, what you have here is the promise by Xi to keep the prosperity dream alive and make that 5% target on growth. ANZ say you could get rate cuts as soon as the end of this month. It's the beginning of 2024. She's packing her bags. She's getting the movers in. She's getting ready to be with me at the end of the month. But day one, what have you got? Good morning, Danny Berger.
Good morning, Manus. I can't wait to be with you in New York. In the meantime, I gotta say, it feels like just the biggest tease of this equity market. We ended the year just about 0.5% away from an all-time high. Just when you think you're gonna get there, this equity market in the U.S. decides to take a breather. We are slightly lower this morning, down about 0.1%, but that's after a furious $8 trillion rally in American equities. Chinese stocks, they're worse off, the worst start to a year since 2019, the biggest declines in about about 3 weeks for the Hang Seng, down 1.5%. Manus, again, as you showed, sure, we're getting a boost from what Xi was saying about supporting the economy, but a factory contraction means that we're selling equities. We are squarely in a bear market. European equities, those head higher, up about 1/3 of 1%, mostly being led by not just economically sensitive stocks, Manus, but a lot of the defense spending stocks, a lot of the oil stocks, because of what's happening in the Red Sea. But as we are headed into 2024, we now head into the year with just this whole raft of projections for where this market goes. Manus, they're very middle of the road, if not slightly higher. But I love what Robico says, that all those predictions for soft landing is just the thing of fairy tales.
Well, the bond market and the equity market, you know, at what stage does the bond market's rally in yields send a more malevolent message to the equity market? I think that's one of the things we're going to debate. This is what the House are saying. This is what Anna Wong is saying in terms of the pivot. The Fed pivot may have stunted the recessionary dynamics in our labor market, but our base case remains a persistent increase in the jobless rate in 2024. And to a certain extent, Danny, that is part of what has lit up that global bond market rally. Of course, UK bonds, German bonds, they are pricing perhaps a harder landing than the immaculate disinflation and soft landing in 1995 revisited that the US bond market has in mind.
Well, we have to remember, we started 2023 with many expectations. There would be that recession, there will be that hard landing. It didn't come. So are people just protecting themselves now? Let's get the view now of Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. And Daniel, not to call you out, but I know you might have been one of those people who thought a recession was coming in 2023. So what did you learn about what you got wrong and what that means for this economy in 2024?
Well, in retrospect, yes. In a sense, you could say that the equity markets were telling you all along that there was not going to be a recession. In the sense, at the beginning, we always had the story that the bond markets were seeing one thing, the equity markets the other. Again, I'm not sure that that was the case. Even if you did have the inverted yield curve, what we didn't appreciate is that was only going to tell you that economic growth was going to slow, which it will. Of course, we appreciate we kind of accelerated into the year end, but that doesn't mean you necessarily get a recession. So in a sense, the message from the bond market was slowing growth. We will get that. The equity market was saying slowing, yes, but not a recession. So from that point of view, it was compatible. And I think that is now the view, really, in a sense, a consistent message you've had from both the bond and the equity markets since last year.
Dan, good morning. Good to see you. So with that in mind, when you look at what's on the board at the moment, 2s, 10s, and 30s, 10-year paper at 394, does that reflect a sufficiently low yield for slowing growth, but not a recession? Or at what point does the bond market flash a real red flag to the equity market?
Well, I guess what are the risks that you see to this kind of very benign environment that we seem to be priced, to have priced in both markets right now? So we appreciate, on one hand, the view being that inflation is going to continue to decelerate towards a 2% target. That may well not happen. We probably see that as the key risk, that we do see inflation stagnating at a higher level than the markets expect. So that's going to mean the market needs to take out some of those cuts from the Fed. Yields have to go back up. The other key risk that we see is, so far, we've had this, generally weaker growth data. That's been good as far, certainly, as bond markets are concerned, because that means the Fed can cut. But it's very easy to imagine a scenario where a couple more data points of weak economic data, the markets start to price in that recession again. So I think from this very nice spot, we're going to go into one of those two directions.
Well, equities even loved it when we maybe had softer eco data, because it says, okay, we're going to cut. Does that hold up in 2024?
Well, we kind of agree with the end point. It's really a question about how quickly we get there, right? We see how many cuts the market has priced in for the Fed. That just seems really nice, but not terribly realistic in our view. We think it's going to be harder to get the next 2% out of inflation than the last 2%. So we think that's the risk. That said, though, it only means that it is unfortunately a bit back to higher for longer, but eventually do get to a lower rate a year from now. But again, just not quite so smooth and as easy as the markets are looking for.
Dan, the other stories that we're tracking as we start the year is how much China will the world want? If you look at what the MSCI China has done since its peak, it's down by 60%. You'll have the bullish analysts saying time to buy relative value. Xi will commit to a 5% growth target. Hurrah, we want to be long China. Is that foolhardy? I mean, this time last year it was long China, the great reopening, it was going to get us all through. We're learning to live without just such munificence from China, aren't we, in the rest of the world? So how do I look at China in splendid isolation or part and upping and grabbing more of the share of the asset management pie this year?
Well, I guess we think about the growth rate that we've had in China and how you would imagine global markets would have reacted to that 5 years ago. I mean, it has been quite surprising that it's been relatively benign in terms of the impact. Growth is slow in China, but thankfully U.S. growth has compensated for that. For this year, I think, as you mentioned, a lot of us have had these hopes of more stimulus, particularly for the property market out of China, but it has been a bit of waiting for Godot. That stimulus just never really seems to come, and I think it's getting harder and harder to think that it's going to. So at this point, we do need to price in kind of a permanently lower growth rate in China. That said, we know valuations are low, but to the degree that that reflects a much different outlook than what we've had historically, they may not necessarily be so out of line.
On a different note, Dan, how do you prepare for the volatility of political leadership in 2024, of half the world's leadership being determined this year?
Yeah, I think maybe it's to kind of identify and focus on the things that really matter. So what I mean by that is, of course, we love to talk about the U.S. presidential election, endlessly fascinating.
The U.S. presidential election doesn't matter, Dan?
Well, the most important thing, honestly, is going to be what happens with the Congress. If the president's party, whoever that turns out to be, also controls Congress, that's when you can do big things, be it Obamacare, be it the Trump tax cuts, be it Inflation Reduction Act, big things. So if you get that type of scenario, then you have something that really is potentially has a big impact on the market and particularly on bond yields. Don't forget the scare, what we were talking about months ago, yields of 5%. The point is that the likelihood of that is relatively low. You tend to have divided Congress, which means you tend to have more of a gridlock situation, in which case, yeah, there's what the president does, but for the markets, for the economy, it really is going to be the Fed that matters.
Shutdown, showdown, we've got 2 dates on the calendar over the next 30 days. The great deal of saber rattling will be done between now and the prospective shutdown. Do we just go through the noise, Dan? Do you just head down, choose the trades, they'll get through it, but there may be some fiscal prudence involved in that?
I mean, that certainly is a pattern we've seen historically. Again, a lot of newspaper articles written in threatening headlines, but in the end, you clearly get the short-term volatility. You could try to trade that if you think you're that clever. But for the most part, we think it is just going to be short-term, and we're trying to focus on the medium to long-term.
Let's just close off quickly in 30 seconds, your call on the dollar, because where the dollar goes sets the tone for the bond markets. Bloomberg have done the numbers. We reckon a 5% drop in the dollar this year. Fill or kill for you?
Well, it probably wouldn't go quite that far, but I think we do anticipate general dollar weakness, particularly against the yen, because where you have central banks with very different policy objectives. But perhaps at this point, given, again, this very benign scenario, all these cuts priced in from the Fed, there probably is more of a short-term risk that reverses somewhat. The next bit of inflation data, if it doesn't show core CPI or core PCE coming down quite so quickly, we're going to have to reassess that view for the Fed.
Well, that's the risk for the bumps in the road, isn't it, Dan, for all of these assets in the first month of the year. Dan Morris joining us on day one of 2024, setting the agenda from BNP Paribas Asset Management. What have we got, Danny? Top stories trending on the Bloomberg terminal as we kick into higher gear this morning. Noel Quinn and the team at HSBC, they are set to debut an international payments app aimed directly at challenging the dominance of the fintechs like Revolut and Wise that have gathered millions of retail customers offering cheap foreign exchange.
At least 30 people were killed and scores injured in a powerful earthquake that hit the Noto Peninsula on Japan's northwest coast, toppling buildings and triggering a blaze that ripped through Wajima City.
And Bitcoin surpassed 45,000 for the first time in nearly 2 years as hopes build of an approval, yes, the approval of an ETF investing directly in the crypto's biggest token. Danny.
I feel like I've heard that one before. Yeah. Anyway, man, it's coming up. We're going to be talking about oil. It's advancing this morning, up 1 1/3% as tensions around the Red Sea intensify and Brent climbs above $78.
There you go. That is moving sharp and fast. Later this hour, Israel enters the next phase of the war with Hamas as it cuts the force size in Gaza. What are the implications? We discuss with our Bloomberg opinion columnist, Bobby Ghosh.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish trend has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
It's your first edition of Bloomberg Brief for 2024 with me, Manus Granny in New York, Danny Berger at London HQ. So oil is on the move. We've got WTI and Brent furiously moving higher by 2.5% this morning. This after Iran sends a warship into the Red Sea. The response to the U.S. Navy sinking of 3 Houthi boats over the weekend, adding to tensions in the key waterway which ships continue to avoid. Let's bring in Al Nightingale for more. Al, so this is very much a scaling up of Iran's direct response to the U.S. How alarming is it? The oil markets, the first time I've seen it woken up so aggressively, 2.5% in the space of this morning. Your first take?
Well, I think the first take is, yes, it's clearly adding to risks. You have to start thinking now that what is the US going to do about it? Do they really want a direct confrontation? Almost certainly not. But that's where we're kind of, we're getting closer to those issues, aren't we? So now you've got two military kind of opponents in the same area. We've got ships being attacked. It just creates this air of risk and uncertainty. And alongside that, we've seen a huge issuance of Chinese import quotas, which, okay, that's very different to the previous narratives that you've been talking about this morning, but it nonetheless does tell you, there's potentially some demand out there.
Is there any way to disaggregate how much of this move is China versus war premium? Because we have seen in the past when, in October, when Hamas invaded Israel, the premium was very quickly priced out.
I think that really, no, is the honest answer. You can't really be sure of what's coming from the Red Sea and what's coming from China. I think that the Chinese quotas were actually quite a big surprise to get such a large number this early in the year. Normally, you kind of find these things out through the year and you get to those big numbers. But now, very early in the year, we know there's going to be a large amount of imports and they could do more. So that's a telling moment for the market, in terms of certainty and demand and all of those things. And alongside that, this Red Sea thing, who knows where it goes and what kind of mishaps can happen and how the West secures that area if it can.
Al, if we have war premium, which was small last week, to say the least, 6 days it took it to accumulate 6%. Here we are, 2.5% this morning. But I want to focus on the demand and the deficit side, because that is what OPEC Plus will be focusing on. I had Amrita Sen with us last week. She said $80, $85 is possible, quite possible, given that she sees a draw coming towards the back end of the quarter. With this China demand story, does that make that even a more robust proposition for the market?
What China is doing is allowing for buying, and I think it's important to differentiate a little bit between demand and buying. What you know is that China is going to be, purchasing these cargoes. It doesn't necessarily mean that the end user demand is there, and that is really important. And it's much harder to be sure about Chinese demand, as your previous guest was talking about, as you were talking about just now. It's one thing to secure the cargoes, to get the barrels in, but if you have that kind of flexibility about when you buy, because the demand actually isn't that strong, then you haven't got that certainty of underlying demand to support the buying and the urgency of buying.
All right. What a way to kick off 2024. Al, thank you very much. Larry Nightingale there, Bloomberg News editor for European oil trading. Thanks so much. And with that in mind, here's what your oil prices are doing at the moment. Up by more than 2% for both WTI and Brent, easily over $73 and $78 for those each. We don't have it up there, but iron ore, based off of China, not off the weak factory data, Manus, but based off Xi talking about a commitment to this economy, that's also up some 2% this morning.
Yeah, and there's lots of juxtapositions like that, Danny, between the data, between the official PMI, which is sub 50, the Caixin, which is, again, showing a little bit better bid, a little bit stronger, I should say, for the second month in a row. But if oil prices rise, and perhaps this inflation narrative needs to be revisited. I'm not saying Jeff Curry and Amrita Sen, to be fair, both called $100 this time last year. If you remember that super cycle, Jeff Curry in his resplendent library talking about his $100 oil call. That didn't come to pass. It definitely, the demand cycle wasn't there. Let's look at the bond market, because, of course, we've had this gargantuan two-month rally in bonds. And what you are seeing is perhaps just a reflection. I think the headline last week was it was Bond Carnival. So I know you were away partying, but there was a Bond Carnival in your absentia.
Sounds like a party.
Well, I love a bond market party, I do. You saw 10% return in November and December. I mean, it was the best 2 months since 1990. Don't know where I was in 1990. German bonds this morning taking higher. U.S. Treasuries, it's a reappraisal of the Powell pivot. Roll it over and you have a look at this global bond market. There are bond markets, I was assured, beyond these shores. 10-year gilts rise by 10 basis points again, and the Aussies playing the catch-up game. That's the state of play in the bond markets right here on Bloomberg, day one of 2024.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model,
Do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Brief, Danny Berger in London, Manish Cranny in New York. And it's kind of a bad start to the year for Elon Musk. There's this new story out from Axios that talks about Fidelity, who was among an investor group that helped Musk buy X. Of course, it was Twitter. They've cut their value by another 11%, which means that X at the moment, Manis, is worth less than a third of what Elon Musk originally paid for it. That hurts.
Look, a lot of this is down to where do the ad sales, what do they come in at? 2023 ad sales are estimated to come in at $2.5 billion. Now, that's way below the prior rate of roughly $1 billion a quarter. So that just shows you the engagement by advertisers on the platform has been hampered. Of course, he did that sort of on-stage conversation, which was quite punchy, to say the least, about what he thought advertisers could do with their money and their attitude.
Yeah.
Kathy Wood, she was with us on surveillance. I can't actually repeat it. I'd get fired if I said anything like that.
Yeah, I was going to say, punchy is certainly a nice way to describe what he said.
I think we'll park that. I mean, Kathy Wood was with us last week, and we were talking to her about, obviously, she's got Coinbase, she's got Bitcoin, she's got, exposure to crypto. And, of course, she has Elon in her family with Tesla up there. She wrote it down by 47%, and that was in the summertime. But it doesn't represent her fundamental outlook or the long-term return on the investment.
Yeah, I gotta say, even though I'm not, a representation of the world, I've been using Twitter so much less. I'm on TikTok. Find me there, at Danny Berger. Just saying, a little plug.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
You're welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Mounting Red Sea tensions, oil prices rise after Iran sends a warship to the region in response to the U.S. Navy's sinking of 3 Houthi boats. Over in China, weak economic data keeps investors cautious. Chinese stocks post their worst start to a year since 2019. And ASML cancels shipments to China at the request of the Biden administration just weeks before an export ban was set to take effect. We're going to have more on that Bloomberg scoop ahead. But for 2023, the doomsday scenarios were avoided. Virtually all of them. We were just inches away from an all-time high to end the year. Well, sorry, folks, it doesn't seem like we're going to get there today. S&P futures down about 0.1% at the lows of the morning. We just needed 0.5% higher to get to an all-time high. Is it exhaustion, or is it just, again, a little bit of a break before we get there? Maybe it's being weighed down by China. Manus, we've been going through some of the data, but the thing that's weighing on this Hong Kong stock market is the fact that factory orders shrank in December by a pretty large degree. Japan is closed today for a holiday, so the Asia trade concentrated among Chinese names. That's down 1.5%, the worst performance in 3 weeks. The one bright spot today, perhaps, is Europe, up about 0.1%. Manus, I know you have oil on your board. A lot of it has to do with this, with oil prices rising higher and defense stocks moving higher, too, because of what's happening in the Red Sea.
Yeah, I mean, I think it's certainly a wake-up call. And if you look at that inexorable rise of equities just before we went home for New Year, and that sort of vicious rise that you had in bond prices and the drop in bond yield, the question you've got to ask yourself, that joint venture, could it last? And it hasn't. It's beginning to unpick on this very first trading day of 2024, which is the bond market is reflecting now on 100 basis points of a rally that it's seen in the last 2 months of the year. And it was a global bond market rally, by the way. It was a global carnival. Look at the bottom of your screen. You've got 10-year government bond yields in the United Kingdom up by 11 basis points. Roll it over, have a look at Germany. There you go, up by 7 basis points. So again, there is this moment of reflection that 100 basis points of a rally was just too much for the bond market. The house view at Bloomberg is that you will see a rise in the unemployment numbers. The shorts, the specs are hellishly short on this by 805,000 contracts. That is the biggest record short by the specs going back over a decade. So there's a moment of reflection in that market. The oil market is not holding back. It's seen this escalation of Iran sending a ship into the Red Sea. The next moment is what level of ratcheting or confrontation do you get in the oil market? Up 2.4% at the moment as the debate about China front-loading their demand. We've just had that conversation in terms of the allowance that they're giving to people to ship more oil. So it's a double punch for oil this morning. And iron ore is up by over 2%. Again, this comes down much more to the rhetoric from Xi Jinping about his commitment to the growth story in China. The Caixin, which is the private sector review of the economy, doing a little bit better than the official one, rising for the second month in a row. So that data, Danny, sets the tone for commodities, and where the dollar goes will also define a great deal of this commodity move for this year. And as a house, Bloomberg reckons, looking at the models, the dollar will drop by about 5% this year. Of course, and rates will define, I suppose, the juxtaposition in the dollar. Danny?
Well, to some degree, that does make sense, because if you look at the G3, U.S. has the most restrictive real rate, so maybe because of that, they can pull back the most, they can cut the most. But Manus, one of the things that's also going to define 2024 is politics. We talked to Dan Morris about this, who said it's not necessarily who takes the U.S. presidency, it's whether there's a joint party in control of both the presidency and Congress who can get a lot of work done. Manus, aren't we so lucky we both get to be in America together for the election year?
I suppose the safe thing for the Americans is you get to vote and I don't. and to that extent, you know, you should be grateful for small mercies that I won't be in a ballot box. But there you go. Look, I think what's going to happen as well, I think this month's going to be really interesting in what happens in these first caucuses, because it's going to define where Haley comes up in the polling. It's going to define perhaps, is there a real opposition? Is there a real opposition to Trump winning the ticket for the Republicans? All of that is in play. But politics, geopolitics, and what's happening in the Middle East will be on the billing domestically. And if we talk about what's happening in the Red Sea, Danny, Iran having dispatched a warship to the area after the U.S. Navy destroyed 3 Houthi boats. This was a move that risks ratcheting the tensions, complicates Washington's goal of securing a waterway that is vital to global trade. Let's set the agenda. We have Bobby Ghosh with us this morning, our Bloomberg opinion columnist. Bobby, Happy New Year. Good to see you. Look, we start the year with a significant escalation, a face-off between Iran and the United States of America. That's how I see this challenge from Iran. Your assessment, and what is the risk of a serious accident politically?
Well, the risk is higher and higher, and Iran just made it 5 times higher or 10 times higher. Choose a number. The Iranian Navy does not stray very far from the waters of the Persian Gulf or the Arab Gulf. It doesn't make its presence felt in the Red Sea. The fact that it has sent this destroyer is a very, very significant event at this particular moment, when you have a flotilla of ships from 10 different countries trying to protect international shipping from the Houthis. Now, the Houthis are a client of Iran's, and Iran sending this battleship is a signal to them of support and a signal to the rest of the world about where Iran stands. It does not stand for the protection of international shipping. It stands with those who are jeopardizing the world trade, in effect. The ship itself, it's a 40-year-old vessel, not a big threat. But the signaling is very, very important at this moment.
Is the signaling also that Iran is willing to get into direct conflict with those that are in the Red Sea right now, or is there still a desire to avoid that?
Well, I think Iran would not like the Alborz, this ship, to directly get involved in any kind of fighting, because it will not be able to hold its own against the navies of the Western world. The United States and 9 other countries are participating in what's called the Operation Prosperity Guardian, and those vessels are far superior to anything the Iranian Navy has. So this is primarily signaling. It is there to reassure the Houthis that they are not alone. And it is there to signal to the rest of the world that Iran has a role to play, that it has a card on the table, to mangle my metaphors.
Let's pivot to Netanyahu and the scale of commitment of troops on the ground in Gaza. I understand a series of withdrawals will happen, about 7,000 troops. What goes through my mind, is this a political expediency, or is this a financial pressure on Netanyahu, or should I read something more constructive on this withdrawal?
I wouldn't read very much, nothing constructive in the sense of reducing the pressure on the Palestinians in Gaza, or reducing the humanitarian calamity that we are seeing unfold there. Economic pressure, certainly. Israel, by its own reckoning, spent about $50 billion on the war, $280 million a day.
Bibi doesn't strike me as a man that's going to pull back because of cash.
No, that's not the only reason. The other reason is he needs to give his troops a break. They've been fighting nonstop for quite a while. And he needs to keep his powder dry, his troops fresh, for a potential confrontation elsewhere in the north with Hezbollah. So there are multiple factors involved here. Remember that the Iranian economy really needs a lot of these soldiers. Many of them are called up reservists. The Iranian private sector, particularly that tech sector, has lost a lot of manpower to this fight. It needs a break as well.
And these were some of the people who, Bobby, before this conflict, were marching in the street against Netanyahu's judicial reform, which has just been struck down by the courts, at least one big piece of it. How does this change the calculation for Netanyahu?
Well, it takes away, it puts more pressure on Netanyahu. He's sort of been consumed with the war, obviously, but this thing, his attempt to change the laws in Israel and the resistance to that attempt from those protests that you were describing, that's been at the back of his mind, surely, because his political future depends significantly on his ability to recast the judiciary. Now, that's gone out of the window. The Supreme Court of Israel has essentially put the kibosh on his plans. That puts more political pressure. He needs to find some success somewhere to balance off against this failure. And that's not good news for a man who is currently fighting a war. The fear is that he'll double down on the war in an attempt to distract from his political misfortunes.
Hey, Bobby, thank you so much for joining us this morning on the first trading day of 2024. Bloomberg opinion columnist Bobby Ghosh. Manis, a good day for Bitcoin, rising to a 21-month high, trading above $45,000 for the first time since April 2022. This is because there is a deadline for a spot ETF to be approved by Jan 10th. But I mean, this isn't new. It's not like anything's changed. I mean, what is this? Maybe just FOMO? I'm kind of scratching my head here as to why we gained so much this morning.
Look, I think you're going to see lots and lots of conversations around why Bitcoin is so strong. And again, this goes back to some of the moves that we saw last week. We saw Cathie Wood goes into Bitcoin futures ETF and dumps Grayscale. So there's lots of pivoting around there.
There is.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
You're watching Bloomberg Brief. Danny Berger in London, Manish Cranny in New York. It's a Bloomberg scoop. ASML is canceling shipments of some of its devices to China just weeks before an exports ban takes effect. The Biden administration requested this as it cracks down on Beijing's chip industry. Joining us now is Alex Webb. Alex, what exactly is ASML not shipping here? What are they holding back?
So they're the top-of-the-line machines of what are known as extreme ultraviolet lithography machines. These are the ones that are not quite as cutting edge as that. They're the deep ultraviolet lithography machines. They had licenses to ship 3 in January. Some of those, we don't know if it's all of them, but some of those shipments are being stopped. And ultimately, China has been in a little bit of a race against time because a ban was going to come in on the sale of these machines. China presumably really wants to get as many of them as it possibly can in order to boost its domestic chip industry.
The issue for the market this morning is to understand the political clout that the US has brought to bear, the tacit acceptance by Europe. Will there be more of this direct interference in terms of what Europe sends to China? But more importantly, if we look at what the outgoing CEO had to say, and he very much was opposed to this kind of maneuver, it's going to hit 15% of the firm's sales to China. Do we have any kind of monetary value, size and scale? 3 deep lithography machines. I mean, how big are these kind of orders, Alex?
So each of these machines costs in the order of tens of millions of dollars. The EUV machines, those are the bleeding edge ones, they can cost sort of $150 million each. So they're big chunks of change. This hasn't so far meaningfully hit, and they already have the ban on the EUV machines, hasn't meaningfully hit ASML's revenue. They have been growing at a fair old clip, sort of 30% in the past year. But the kind of political implications of this, there's a lot of debate, push and pull, right? Because on the one hand, they say, well, but people will say that if China can't buy these machines, it gives it a huge incentive to try to develop its own. At the same time, it's very hard to develop these things. It's not just about, you don't just go and build the machine. The supply chain to get the parts to build the machine is also vastly complicated. So when it comes to the effect that the US has on European exports, ASML is really the only player in this game. It's whether there are companies in the supply chain that China might try to get in on, whether they become the next round of people that are affected. But China is years away from being able to replicate what ASML does, which is why these machines are so important geopolitically.
Okay, well, let's see where this story goes. You're certainly seeing a bit of an impact on the stock this morning, down 1.2%. The rest of that supply chain in Europe also under a little bit of pressure. Alex, thank you very much. Alex Webb. And ironically, it was, of course, the chip makers, which were the best performing sector in the United States in 2023. Let's talk about the Chinese automaker BYD. They had a record sales quarter, putting the heat on Tesla to maintain its #1 position. Now, it comes a long way since Elon Musk had this to say about the automaker. It was 2011, and it was Betty Lou. Take a listen.
BYD is trying to compete. Why do you laugh?
Have you seen their car?
I have seen their cars, yes. In fact, at the Berkshire Hathaway meeting, I saw their cars.
Yeah.
Well, they are on a different, tell me why you're laughing. You don't see them at all as a competitor?
No.
Who's having the last laugh now, then? BYD, maybe. Craig Trudell is with us. Craig, good to have you alongside us for the first day of Conversations of 2024. How worried do you think Elon Musk is about BYD? He's been slashing prices. BYD is there. They're not just snapping at his heels, they're smacking him.
Yeah, I think it's a foregone conclusion at this point that BYD, passed Tesla probably by tens of thousands of units. We'll find out exactly how much the differential was in the next couple hours. But I do think that, in Musk's defense, in 2011, BYDs were not particularly attractive. They were maybe worthy of a little bit of snickering relative to what Tesla was selling at the time. But just in the last few years, this is a company that's really emerged unlike anything that we've seen in years in this industry. It's a company with a really actually good-looking model lineup, competitive. They're much cheaper than Tesla's vehicles for the most part, and so these are two companies playing very different games in terms of what sorts of consumers they cater to. That being said, I do think that, Musk is, is absolutely taking BYD seriously now, and we've heard him said as much, somewhat recently, talking about the idea that they are very much to be taken seriously and a competitor to Tesla to be reckoned with going forward.
How seriously should Tesla, should Porsche, should all the EV makers take Xiaomi coming into the EV market now?
It was really interesting over the break, Xiaomi coming out with an electric vehicle that, they came right out and said that they see this as a Tesla and Porsche competitor. I think, what we've seen with Huawei, before this, this is a very similar model of tech companies with, mobile phone customers and quite big, consumer bases that are really loyal to their brands. Partnering up with state-owned car makers. They handle the sort of, nitty-gritty, less exciting parts of the car. But these tech companies really controlling software and, the chips and the sorts of things that, they really excel at in the mobile phone space. And we've seen Huawei really, make some pretty big waves with their initial model in China. So absolutely, the incumbent car makers are looking at this trend very closely.
Yeah, and that Xiaomi SU7 has a pretty broad range. Looks pretty slick. I've got to say, I've been in a lot of Teslas over the years, unimpressive, and I've been in a lot of alternative brands in Europe, which are quite stunning when you get into them at Zurich Airport versus the ones that you get into. And I've got to say,
oh, Manus,
yeah.
I got an Uber with one of those Tesla SUVs where the doors go like that, and I am amused very easily, and I was pretty amused by it, I gotta say.
I think I get it. There's the whole sort of gull-wing thing, and I've done that to the airport as well. But have you seen the finish inside these things? They're like pieces of tin. Anyway, just a thought. Style over substance wins every time in my view, Craig.
That's the kind of man you are, Manus. And here I am just being like, oh, pretty doors, how exciting. Hey, Craig, thank you so much for joining us. Bloomberg's Craig Trudell. All right, coming up, we're going to set you up for the week and look at some of the market-moving events for you to watch right here on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So look at what's ahead this week, the first full week of 2024. U.S. PMIs come out at 9:45 Eastern time, followed by ISM manufacturing on Wednesday. We're also going to have Fed speak, Richmond Fed President Tom Barkin, and get the latest FOMC minutes. That'll also happen on Wednesday. That's all ahead of Jobs Day in America on Friday. And Manus, this is the thing that's really going to set the tone for this bond market for 2024. Can the party continue after we were able to notch out some very slight gains for 2023?
Well, the risk is that the minutes reaffirm the Powell pivot. Isn't that my risk, Danny? But if you look at the bond markets this morning, they are really pausing and reflecting, because we had this monster global bond market rally. There's German bonds up by 5 basis points this morning. The UK and Australia also playing that catch-up game. In many ways, there was just so much priced in. Now, if the US bond market is priced for a, soft landing, non-hard landing, it's the rest of the world where you may see yields drop more precipitously, Danny, relative to the US.
Well, that gets to the argument about the dollar. So many people have said that this is finally the year that we're going to see some dollar weakness. But if you have a weaker economy throughout the rest of the world, and rates are coming down more in the UK and Europe, yeah, exactly. It's all about the dollar. The only thing I will say, Manus, and Bloomberg points this out, is that real rates are more restrictive in the US than its other G3 counterparts. So they do have a bit more room to cut, and maybe for that reason, the dollar weakens.
Look, we're going to roll forward. Have a look at the break-evens, because this is the view as well. Five-year swaps, by the way, are back at 2.5%. So we are below the average. But when you look at the break-evens throughout the market, what have we got? We've got 2s, 10s, and 30s for you. As we start 2024, inflation has been vanquished. Your risk, not vanquished, but that disinflation story has taken hold. The question for the market is this, is whether there's a re-spike or a re-ratchet of core inflation. That is the risk to the bond market as well.
And this is something Dan Morris from BNP Paribas, who was with us earlier, was talking about, that one of the negative scenarios, not even that inflation re-ratchets higher, but that it just doesn't come down with the same speed and velocity that it did in 2023 that allowed us to price cuts. Maybe a slower movement to 2 is enough to undo the 150 basis points cuts that are priced in.
And that's essentially what we saw from Larry Summers as well, really warning about the resurgence of an inflation spike. So everything's priced for 1995, but the question is, will it be delivered? In terms of the kind of narrative for today, still global stocks are 11%. Global stock markets are below their all-time high. So there's still some mileage left in the equities. But what else are we going to keep an eye on? I suppose it's going to be Tesla. Would you buy a Tesla? I'll leave you with that thought, Danny.
I'll buy a Tesla if I can get the Gullwing ones, maybe. Maybe that's all it takes for you EV car makers to sell us. Just some fancy doors for Manus and me.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
'24 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility.
What I'm excited about in 2024 is to not hang on every single word that the Fed is saying.
Powell thinks the Fed's going to be cutting rates in 2024, but it's possible that the economy could be firmer for longer.
If our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
The Fed is really unlikely to start cutting in March.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Are the mics on? Are we ready for this? We ready? Okay.
Oh, yeah. Happy New Year.
Let's get this year started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 this morning, negative 0.1%, hitting the ground running for 2024. Payrolls on Friday, the following Friday, earnings season kicking off with earnings from JP Morgan. Tom, starting the year on a 9-week winning streak on the S&P 500.
The winning streak's there and it's catch-up. I think what's so important here is it wasn't about the big 7, big 8 stocks. It was about a catch-up being done. And you just wonder, what's the character of the follow-on? If you assume bull market, John Stolfus with us, the Super Bowl in the 8 o'clock hour, and you wonder, okay, if we're going to be bullish, what kind of bullish are we going to be? We got to learn how that works out in January.
Well, let's talk about the scores of the last 12 months. Lisa, the S&P 500 up by something like 24%, the NASDAQ 100 higher by 54%. And the range of forecasts on Wall Street coming into this year, you can drive a double-decker through them. 4,200 at the low end, JP Morgan, 5,200 at the high end, Oppenheimer.
And they're all unusual in the sense that they're all predicting a less than a 10% gain or loss for the full year. And to me, what I was struck by is that's really rare. We've seen 20% up, 20% down pretty consistently for the past couple of years. And you'd have to go back to 2016 for a gain below 10%.
I think it's important. John really laid out nicely the calls out 1 year forward. John, I thought over the weekend, over the long holiday, there was way too much short-term analysis. I went over to where we were 12/31/19 from the beginning of COVID. SPX up 12% per year, Dow up 10% per year, NASDAQ up 19% per year with a super 2023.
We had a decade in 12 months, Tom. A decade worth of stories
nicely said.
In 12 months. We had a banking crisis, Lisa, for about 5 minutes, moved on from that. We had this story of higher for longer, yields through 5% on a US 10-year, moved quickly through that. November and December happened, Lisa. We had this AI phenomenon that could continue through 2024 and beyond, maybe for the next several decades. How many stories, how many themes were there? And I mean major themes for 2023. Ozempic, another one.
Exactly. And honestly, for New Year's Eve, I was going into 2024 and I was thinking, we're going to have an
another decade in a year. Think about all the themes that we have set up just for January. Think about all of the potential outcomes that could be, the headwinds that could transpire. To me, that was sort of exhausting to think about. We could have another year of a decade of narratives stuffed into 2024.
No time for rest this morning. Wall Street getting back to work. Barclays, Tim Long on Apple. We are lowering our rating from equal weight to underweight. The iPhone 15 has been lackluster. We believe the 16 should be the same. We believe the continued period, Tom, of weak results coupled with multiple expansion is not sustainable.
This is the key point. You've nailed it, and you've nailed it with the one stock people care about is multiple expansion. That was the gift of last year. We'll talk about that through the 3 hours this morning, but the answer is, what character is the bull market this year? Can you get it going with the kind of multiple expansion of the last 12 months? In Apple's case, it was ginormous.
Down in the pre-market by 1.6%. Let's get your morning started, your week, your month, your year, with some price action. Equity futures on the S&P 500 shaping up as follows. On the S&P, we're negative 0.15%. Your 10-year yield, 392.57. It felt like at times, Lisa, this bond market was trolling us all. Just to think about everything that was going on last year, and then to finish almost exactly where we started 2023.
I feel like the entire market's been trolling us, considering the fact that with S&P, the whole round trip, we basically are back to where we were in January of 2022. What we're looking at this week is really going to be massive jobs numbers, and I'm really watching the labor market for clues of whether we're going to surprise the upside or surprise the downside economically. On Wednesday, we get ISM manufacturing for December. That'll be interesting to watch. But we also get the FOMC meeting minutes and the JOLTS job openings, and I'm watching job openings even though a lot of people discount this as a sort of non-metric that is highly fudged by people posting 3 jobs at a time. That said, does it continue to go down given the fact that people are seeing perhaps a little bit more labor come into the market? Thursday, initial jobless claims. I'm watching continuing claims, which have been ticking up. And on Friday, we get non-farm payrolls as well as ISM services. I am watching how much pay is increasing still. It is still increasing too quickly for the Fed to be on a trajectory where they're cutting rates as aggressively as the market is currently pricing in.
For once, the minutes could be interesting, right?
We say
Did
that
they
every
talk
time.
about it? Are they actively talking about it? We're told they're not talking about it. They're kind of talking about it.
Okay, but they have to say that they're talking about it at this point, because otherwise they discredit themselves completely. If they don't address it, and it just is their throw Powell under the bus, at what point are we talking about something that just lacks any credibility whatsoever?
We're going to have John Stolfus later and Uber Bull here. He's modeling out, John's modeling out 11% earnings growth. That's all the Fed's got to know. I mean, the juggernaut continues, and on any number of analysis of real rates, they're way behind it. They got to cut. And we'll see. No, there's a lot of sophisticates don't believe they're going to do that.
The biggest bull on Wall Street, John Stolfus, a couple of hours away. We start this morning. We start 2024, I'm pleased to say, with Chris Marangi, the co-CIO of Gabelli Funds. Chris, wonderful to catch up with you, sir. There is a range of questions that you ask in your note, and I want to pick up on the last one. I think is the most important. Where the leadership's going to come from in 2024. Where do you and the team, Chris, believe that leadership will come from?
Yeah, so 2023, obviously, the leaders were the big tech-enabled companies. They were safe havens, fortress balance sheets, great cash flow, great places to hide out in economic and political turmoil. We still have a lot of that turmoil, obviously, but you've got the Fed wind at your back in 2024. You've got an economy that has probably hit a soft patch, but I don't think is going off a cliff. So I think that gives some room for a broadening out of the market. Small caps had a great December. I think that probably continues into at least the early part of 2024. So a broadening of the market, some of the neglected sectors, neglected size companies.
Is there a part of value, Chris Marangi, with all of the Gabelli heritage that is growthy? Is there value, and then sort of growthy value?
Yeah, we tend to look at those growthy values. Growth is neither good nor bad. It depends how it's priced and whether it adds value or not to the firm. So yeah, we love growing companies. There is the cigar butt investing flavor of value investing, where you're looking for companies that are not growing, and we've got plenty of those too. But again, you're looking for what's it priced.
Give us an example of a growthy value stock. It's not Apple or Microsoft, is it?
No, and some of the sectors, by the way, that we're looking at in 2024 are some of the defensives. There's some growth there as well. If we are going to hit a soft patch, many of those companies were hit by higher rates and should look to recover in 24. Those would include some of the staples. And one growthy staple that we like is Bellring Brands, BRBR. Hope you started your day with a protein shake. That's what they make. They are very on trend.
does that. Birthday Boy does that,
growing over 30%, and this thing is just a rocket. Lots of other companies would love to own it, and we think there's some opportunity there for them to be taken over in 2024.
One thing that you do so well, Chris, is you do fundamental research, and last year it seems like a lot of fundamental research died. Do you think that this year it'll actually translate into performance that much more at a time where, if you talk about the growthiness, Apple didn't really have sales growth when it came to the actual unit sales. A lot of people are wondering whether they're going to get punished for that, as John was mentioning earlier this morning. Do you think that fundamentals will reconnect with stock performance this year?
Well, hope springs eternal at this time of year, always, Lisa, and I do think that's true. Listen, last year, obviously, you buy 7 stocks and you did great. That's going to be a little tougher to do. You know, the Magnificent Seven, some of them probably will do well again this year, but it's not going to be across the board, and it's not going to be to the extent that we saw in 2023. So you're going to have to do some work, and those small caps require a lot of work. They're just harder to find information about them. You've got to go out and visit them, and that's what we do, and that's where we think we can add value this year.
Just on a sort of whim that you do invest in some of the Magnificent Seven stocks, which ones do you think are going to be the winners, and which do you think are going to be losers?
Well, you know, we're partial, just given our background, to some of the ones that look more like media companies, the ones that have been eating advertising, in fact, eating the whole advertising pie. You know, those have been Google and Meta in particular. And you think Meta still has some room to run. It's not expensive. Zuckerberg has shown some cost discipline, which I think will continue, and they continue to take share in advertising.
Chris, 194% gain year to date last year. If you weren't in that name, you were in that name, Chris. If you weren't in that name, would you suggest that people add fresh capital to it, given the move we've seen in the last 12 months?
Yeah, listen, I think the market doesn't know how much it was up. The stock doesn't know how much it was up last year, and just looks at what the earnings are going forward. And you know, over $20 a share, it's not an expensive stock.
TK, Meta up 194%, Nvidia number 1 on the S&P 500 last year, up 238.87%.
A nice lineup, and what's important here to Mr. Marenghi and Mr. Gabelli's effort is you got to have a 3, 5, 10-year perspective. Which of those tech superstars, John, do you have courage to own out 5 years, or 7 years, or 10 years? I don't hear enough talk about that in
What
the
you heard from
financial
Chris
press.
there, I think, is really important, though, Tom. The stock market doesn't have a memory. That individual stock doesn't have
Yeah, what I notice here with Marenghi, and Lisa, I think this is important. He goes right to the glazed donut. I mean, that's what he's doing. He's got bell ring, 420 employees in St. Louis, BRBR.
Oh, you've done your research.
And they got to deal with the Dunkin' Donuts, where they're putting a hydrolyzed whey protein isolate on a Dunkin' glazed donut. That's why Mario Gabelli went into this, is because it's donuts.
Okay, you know what? Let's go there. And just, I would love a final word from Chris on Ozempic. Is he worried about Ozempic with that glazed donut? Chris, is that something that you're really thinking about?
Well, that's why we love BRBR. It actually is on trend. You need protein support if you're on any of these drugs, and so they're a beneficiary of actually the semaglutides.
Chris Marenghi, thank you for making that work. Appreciate it, Chris. It's good to catch up as always. Happy New Year, sir. Chris Marenghi there of Gabelli Funds.
There's the banner headline: Mario Gabelli on trend with glazed donuts from Dunkin' Donuts with Ozempic going on.
I feel like I'm you, Tom. I feel like I want to bite my tongue so hard.
I'm just over here
How
biting
many
the
times? Basically, they're sort of dressed
Way
up
to start the
candy
year.
bars. Well, there's these dressed up candy bars. They've got a little whey protein in them, but they're called a health shake or a health bar. I mean, this is the same thing.
That's how it works.
I mean, that's exactly how it works. And it's chocolate coated, and it's got, you know, Splenda in there, so it doesn't have as much sugar. But essentially, for all intents and purposes,
I walked by a Krispy Kreme on our sojourn.
Oh, tell us more.
We were going to, you know, should I go in and buy a dozen for the team? And,
you will.
And did you do that?
It was unhealthy. It would be sending a bad signal.
Okay.
It was.
Well, that's
not
one company. Let's talk about the others. We've mentioned big tech, and I went through Nvidia, number 1 performer on the S&P last year. Number 2 was Meta. Royal Caribbean, number 3. Number 3, Tom.
That was a bounce.
Up 162%. Carnival in the mix as well. Number 6 stock up 130 on the year.
You bring up a really important point, folks, and this dovetails into the economic data we're going to see this week. Is some of these things are off the bottom, like maybe cruise ships off COVID. Maybe China's on the bottom right now. That's a huge unknown. But these others are growing companies, and we can argue about the valuation model. We'll talk about that through the 3 hours today. But the answer is there's 2 discussions here. Growing companies, how do you price them? and off the mat last year. How do you come off the mat of 2023? Doesn't exist.
And ultimately, Tom, the question on leadership, where that leadership's going to come from in 2024. And Lisa, towards the end of the year, I think a lot of people, once again, for maybe the second or third time in 2023, got bulled up on the idea that discretionary can continue this performance into 2024. The likes of Neil Dutta, Renaissance Macro, who's really putting out there that he thinks that this resilience, this economic expansion can continue because real wage growth is going to remain decent through the year ahead. And ultimately, that's going to support this discretionary thing.
If that is supported, then shouldn't the gains be a lot more than 6 to 9% on the S&P 500? If that's the case, don't you see big tech hanging in there, not necessarily declining, and everything else catching up? And this, to me, is sort of the big sort of unknown. If the consensus is always wrong, the consensus calls for some sort of medium performance. So where is the outperformance or underperformance?
But what's the efficacy of watching Bloomberg surveillance? Here's the answer. John Farrow puts out J.P. Morgan 4,200. Oppenheimer 5,200. So there's a 1,000-point difference at Standard & Poor's 500. I can't even do the math. It's 20% variance or whatever. This is all BS. I mean, that's all there is to it. And the answer is you take this to find your confidence if you're in the market.
What's the efficacy of surveillance? And then that final phrase. Okay.
No,
it's a good start to the year.
Why are you watching this? You're watching this because we'll give you perspective.
It's a big question, TK. From New York City this morning, good morning. Coming up a little bit later, Sarah Hunt of Alpine Saxon Woods and the big bull on Wall Street, John Stolfers of Oppenheimer, about 2 hours away. From New York, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
One, just to reiterate what I said before, we're going to do what we have to do to protect shipping. Number two, we've got significant national security interests in the region just on our own, the United States. And we're going to put the kind of forces we need in the region to protect those interests, and we're going to act in self-defense going forward. Again, I'm not ruling anything in or out, but we have made it clear publicly to the Houthis. We've made it clear privately to our allies and partners in the region that we take these threats seriously, and we're going to make the right decisions going forward.
Things looking increasingly fragile in the Middle East. That was John Kirby, the National Security Council spokesperson, speaking on ABC over the weekend. Live from New York City this morning, good morning and Happy New Year to our audience worldwide. Let's check in on the price action to kick off 2024. Equity futures pulling back by 0.4% on the S&P 500. Just a little bit lighter, softer, negative, lower. Off the back of this, maybe. Check out Apple in the pre-market. Down off the back of this move from Barclays and Tim Long. Lisa, we're lowering our rating from equal weight to underweight. We believe the continued period of weak results coupled with multiple expansion is not sustainable. That stock is down 1.6%.
And they're not alone. And this, to me, was something that I found interesting over the past week of reading. Michael Batnick over at Ritholtz Wealth Management put out projections that he admitted probably were fantasy, just given the fact that all projections are, to Tom's point earlier. But he said Apple, the business, didn't have a great year. In the last 12 months, revenue is down, expenses are up, and operating income is down. This raising a question, does it have the growth of the other Magnificent Seven, and does it belong there?
It was true all year. And we asked that question every month, every quarter, and stock ended, Tom, it ended the year up by 48% year to date for 2023.
I'm going to say the multiple expansion for later, but right now I got a 29 multiple, a 31 multiple, and on their massive growth, subpar compared to others, it's a 29 multiple stock. And so you say to yourself, where's the growthiness of these research notes, the concern at Barclays? And the answer is they're not running this for growth, they're running it for profit. It's a profit juggernaut, and use of cash is everything at Apple.
To your point, still a monster cash machine, Tom. Spitting off
there's no comparison.
Billions and billions of cash, which is going back into big buybacks and shareholder rewards.
I mean, I just can't say enough about how the Magnificent Seven, John, aren't just seven as they are. We're going to move forward here now, and of course we look forward to the politics of the Monaghan futures down 22, the VIX 13.68. Jennifer Flitton is head of U.S. Government Affairs at Invesco and joins us on the 14 things that we need to focus on. Jennifer, I'm going to talk about something that I was shocked didn't come up this weekend. It's a calendar item. It's January. And January means you're going to be in your LL Bean boots in Concord, New Hampshire, watching the show go by. Does New Hampshire this year matter?
Absolutely, New Hampshire matters. I mean, this is the first primary in the nation. It is right after, 7 days after the Iowa caucus. And quite frankly, the best chance for Nikki Haley to really take hold in this race is in New Hampshire. And if she can't, this may be locked up rather early this year for Donald Trump.
The uproar days ago of Ms. Haley and the idea of slavery, misstatements, incorrect, whatever the debate was, will that affect her in New Hampshire?
Well, I think it remains to be seen. I think Chris Christie is certainly trying to take advantage of that misstatement that she made a few days back. You've seen her try to change the news cycle, but I think we're on like the 5th or 7th cycle here, and it isn't, she's not shaking it.
Well, given the fact, Jennifer, that Donald Trump likely is the Republican nominee and pretty much all the polls are pointing in that direction, how will he really influence some of the key debates that really are going to happen way before the election, including in 17 days' time where we could get another government shutdown?
Yeah, that's excellent point. And that's what we're really watching here. And it is the government, potential partial government shutdown here on January 19th, and then another risk then on February 2nd. But there's also this defense supplemental. And so his reading of whatever sort of negotiated package comes out in the next week or so on immigration, Ukraine, Israel, Indo-Pacific, and border policy, that could sink or allow for this defense supplemental to actually take hold and pass through Congress and signed by the president. So I think we're watching his reaction rather closely to whatever comes out when Congress comes back next week.
Which really raises this question about whether there is more urgency around providing aid to both Ukraine, given the offensive that we've seen, the aerial offensive from Russia, as well as from Israel, especially given some of the Houthi attacks and the recent Iranian warship. Do you expect the attitude in Washington to have shifted about really voting for aid in a much more significant way?
Look, I mean, Ukraine aid is completely tied to border policy. And that is only getting more tense due to the fact that we have close to 300,000 people who have now come over the border just since December 1st. We're breaking new ground here. And so the reaction, and we saw it on the Sunday morning shows from Senator Graham and from Mike Rogers, those who really would like to see Ukraine aid happen, and they want that support from the Republicans in their conference, they know it has to happen alongside strong border policy shifts. And so we're still waiting to see what it is that they've come up with. They're still drafting that language.
Well, Civics 101, I mean, we're talking about a lot of Republicans here. Does the administration have a border policy after the cacophony of news the last 10 days?
Well, I think they have a border crisis, and I think there's an acknowledgement, especially among Democrats who are in difficult districts. You know, you have in the House specifically, you have 24 roughly toss-up districts, and number of those Democrats who are in those tough races are really looking for a resolution here. And you see this especially down in Texas, New Mexico, Arizona. There has to be some sort of dealing with this issue, and not just for House members, but also for Senate, these toss-up Senate races in Arizona and Ohio, Montana. You know, they need resolution here, and it's going to have to be part of this defense supplemental.
TK, the optics for the White House over the last week or so, just absolutely terrible. The president's on the beach. At the same time, U.S. border officials are processing more than 300,000 migrants for the month of December, potentially the highest monthly tally on record.
It's extraordinary, and to follow this across the life of Bloomberg surveillance, it's an intractable issue that everyone wants to dodge. For us in New York City, folks, it's visceral. I think the latest thing I saw within the zeitgeist is the buses from Texas are now being dropped off in New Jersey because the mayor and others in New York City have said, no, you're not going to drop them off in New York State. What do those good people do in New Jersey? That's the immediate question.
Jennifer, just to squeeze in an additional question if we can on that point, how does the president between now and early November convince the electorate this is something that he can do something about?
Well, and that's why the next several days really matter. So if it's not tied to defense supplemental, then it's going to have to be tied somehow to appropriations. You're going to see this pressure rise when Congress comes back next week. It's not going anywhere. And there has to be some sort of resolution for this administration going into what may be an early start to a general election.
They've got a lot of work to do down in Washington, D.C. Jennifer Flynn there of Invesco. Jennifer, thank you. Lisa, we've got these two deadlines coming up for spending, potentially talking about government shutdowns, never mind the election out there in November.
It's going to be messy. It's going to be really messy because it doesn't seem like there's any resolution. And frankly, there's been discussion from Mike Johnson, the House Speaker, that there are going to be separate bills for each one of the spending packages. They don't have time to get past something like 17 independent bills.
I suggest it will be October of next year, a focal debate, and it will go right into the presidential election that we'll see in November.
Those two deadlines we're all looking for. January 19th is one, February 2nd is the other. Coming up shortly on the outlook for the economy in America, Bruce Kasman at JP Morgan. That conversation just around the corner from New York. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York, here are the scores on the S&P 500, kicking off 2024, pulling back just a touch on the S&P. We're negative here by 0.5%. Lighter on the NASDAQ, taking things down by about 0.85%. Lisa, the majority of this, would you say, down to that downgrade from Barclays on Apple? Apple down this morning in the pre-market.
Especially because it really comes after so many people have pointed to Apple as a potential outlier of the Magnificent Seven, not delivering the same kind of sales growth. Those shares down 1.9% in pre-market trading. So yes, given the weight of them, this one stock can bring everything down, just reminding us how important it is to get the Magnificent Seven right.
I would say there's a set of opinions on Apple. Let's go to 4 trillion man. Dan Ives at Wedbush models out 3 trillion to 4 trillion in market cap out 18 months. He doesn't really put a timeline on it, but this is the bet on these stocks, whether you're pro or con, it's more about the business strategy, the structure of it, than it is about gaming stock price.
As Lisa mentioned, we're down almost 2% in the pre-market. Let's turn from stocks to bonds. In equity land, 9-week winning streak on the S&P 500. In the bond market, November, the 10-year yield down 60 basis points. December, the 10-year yield down almost 45 basis points. This morning in January, Lisa, up 5 or 6 basis points, back to 393.50.
Basically where we started last year. Again, this is sort of, to your point, trolling us because we see this wild shift up to 5%, wild shift down to sub 4%, and we're just we're back where we were before. Right now, it's very unclear to me whether people are going to get worried yet again about inflation when you start to see a labor market hang in there and an economy that's okay.
But the micro trends there, the United Kingdom, John, you know this, 7.7%. I mean, Greer's they're going to lower their prices. 7.7% down to 6.7% on food prices. That from Katie Linsel and Queen Victoria Street. And the answer is there's Spain, there's London, there's Germany, there's the U.S. There are these micro datas of disinflation, including the deflationary impulse of China, which gets you to the enthusiasm.
Let's turn to foreign exchange, Tom. Push out some of those bond markets through foreign exchange. Those big moves in bonds, taking down the US dollar. The first down year for the dollar index since 2020. The euro through 110 briefly. Lisa, back down to 109.79. But if you look at some of the ranges, some of the levels we've gone through, think about the move we've seen in the Swiss franc as well. The recent weakness in the dollar and the strength elsewhere has been pretty notable in the last month.
And it's all really stemming from this idea that the Fed is going to cut rates more than 3 times, maybe 5 or 6 times this year. Why? If there isn't true weakness in the economy, can they do that? And we're going to have to talk about that, even though people are sick of that conversation. It will still dominate things in 2024.
Can't wait for the Fed minutes a little bit later this week.
A lot of people.
Did they talk about it? Are they actively talking about it? TK might read them as well. What time are they tomorrow?
I think they're at 2 p.m.
Cannot wait. Okay. Good start to 2024. Under surveillance this morning, crude gaining as Iran ramps up tensions in the Red Sea. Tehran sending a warship to the area after the U.S. Navy destroyed 3 Houthi boats over the weekend. Maersk also suspending all Red Sea transit in order to assess the situation. This one has been simmering now for the last 3 months now, Lisa, and starting to get to boiling point more recently.
Well, especially the fact that Iran is going to directly bring their own resources into the region. This is sort of getting closer to honestly what we've been hearing from Mitch McConnell and others, the direct confrontation between the U.S. and Iran, and what really will trigger that if you have both U.S. warships, Iranian warships,
Right.
the Houthi militants, and the U.S. willing to shoot them down.
You know, Elliot Ackerman's scheduled to be with us here with a wonderful book, 2034, and that's all about unintended consequences. And this is how you do it. You've got things in a sea contained like the Red Sea, and, you know, they got the best of plans, the best of hopes, and then there's oops. And that's the risk that's out there right now is one oops, two oops, or sequential mistakes being made.
Deeply upsetting images coming out of the region in the last 3 months or so, the last 2-3 months. Shocking images coming out of Japan over the last 24 hours, including these. A Japanese Coast Guard plane colliding with a Japan Airlines flight at Haneda Airport in Tokyo. All 379 passengers and crew on board. The larger plane safely evacuated, according to a spokesperson, but 5 of the 6 crew on the Coast Guard plane are unaccounted for, Lisa. The smaller plane was carrying aid to northern Japan, where its 7.6 magnitude tremor hit the country. At least 48 people have died. We understand from the latest reporting coming out of Japan that 5 are confirmed dead in that Japan Coast Guard plane collision. That news just coming through moments ago.
And it's just horrible, considering the fact that they're also reeling from what we saw with the earthquake. Whether this was related or not, very unclear about what some of the details were in this. But there's a real question here about how this country is going to really evolve. You're seeing the yen respond in early morning to the disasters.
I bring it across the world to here. We're off of COVID and off of the challenges of American transportation system. There's a real worry, John. It's unspoken, sometimes reported on. People are worried about order at different airports. You know, in New York, we're focused on this, but this is not just a Japanese issue.
Let's say developing story in the last 24 hours, particularly that crash in the last couple of hours. Any more on that, we'll bring those details to you. Wanted to finish on this. Dutch manufacturer ASML bowing to pressure from the Biden administration. According to Bloomberg, the company cancelled shipments of its chip-making equipment to China weeks before export bans came into effect for January. The Biden administration is cracking down China's efforts to make advanced semiconductors and Lisa, progress in AI.
And this, to me, comes as the ASML CEO talked last year about how they're going to lose some 15% of their revenue from China as a result of some of these bans, yet still going ahead with this because it's not just the United States. It's also European countries trying to restrict China's ability to develop some of the chips in the iPhone rival and other things that they're developing. This, to me, is really the key area to watch, especially as you hear Xi Jinping with some niceties where you're memorializing the ties between the U.S. and China that were initiated in 1979, and Biden trying to make nice noise. This is what you need to be watching.
But it's the mystery. I don't know if you agree with me, but I would say China is a simple mystery for this year. Was it going to do 5% GDP, and also, of course, all the politics as well. Let's turn to that, some of the mysteries of your 2024. Bruce Kasman-Breese, Chief Economist, J.P. Morgan. Bruce, thank you so much for starting our year strong. I'm going to cut to the chase. There's an enthusiasm out there. Tony Dwyer over at Canaccord Genuity just says investors are giddy. I mean, there's just no other way to put it after what we've seen in Q4. Do we have the animal spirit, the nominal GDP, to sustain our collective giddy?
Well, I think on the one hand, there is a support for growth here that's already reflected in the health of what is both the private sector on the household and the business sector side that should continue to keep growth going. And now we've got an additional push coming from financial market easing. So I think the prospects for growth here, while not boomy, look reasonably good. The question is whether the enthusiasm, which is being driven in large part by expectations of substantial Fed easing in the first half of the year, is going to be realized. And here we think there's probably going to be a bit of a speed bump that comes in the way, because I don't think inflation will keep coming down in a way that will deliver that outcome.
Well, to the speed bump, you've provided this. As you well know, Michael Feroli's on the short list to be the next Fed governor. But the answer is Feroli of J.P. Morgan has a potential GDP of sub 2%. John Williams has an R-star that's back down to what it used to be pre-COVID. Should we just understand we're going to migrate at some point back to the Feroli lower levels of real GDP?
Well, I think it's pretty unclear right now, given how much the shocks from the pandemic have kind of affected things. My own view is that R-star is higher. I think it's shown in how the economy has performed over the last year or two. I don't want to argue that's a long-term estimate, but I think the economy is in a healthy position here. I think it will take higher rates to be sustained here to continue to bring inflation down. Inflation is not going to stay high as it was over the last 2 years, but I think getting down from 3 to 2 is probably going to take more work, and I think it's not going to happen quickly. And as a result of that, I do think the Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
Bruce, as you know, as we all know, the last 12 months marked by recession calls that never really materialized. What have we learned in the last 12 months about which data points are relevant and which data points are totally irrelevant? Because I'm looking at a manufacturing ISM that comes out later this week, which has been sub 50 since November 2022. How useful is that?
Well, I think what we've learned or should have learned here, first of all, that forecasting is hard, and that's something we should always be reminded of. But I think importantly in this environment, we should learn that there's a whole set of things happening in this pandemic recovery which are unusual. 500 basis points of Fed tightening traditionally deliver a recession, and that's what a lot of people were basing forecasts on. But as you noted, even as manufacturing globally has been soft, the service sector has been lifting as a result of pandemic normalization. In the U.S., you had a big fiscal impulse, which I think people missed last year. And more generally, the underlying health of the household and business sector, I think, is something that's not usually in place when the Fed is tightening a lot and has provided a real backdrop of resiliency. Resiliency has been the theme, not strength so much. And I think it's still in place here. And I don't think we should bet against the U.S. or global economy, at least not over the next 6 months or so.
To build on John's question about which data points matter, I do wonder about the stacking of all of the employment metrics that we're going to get this week, really topped off with that non-farm payrolls report. How high is the bar for either wages to increase, for the numbers to stay high, for the market to wake up to the realization that you're talking about, that frankly, the Fed cannot cut rates 6 times this year, and that the economy is much stronger and inflation, unfortunately, a bit stickier?
So I'd say first off that the payroll report, the data we're going to get this week are going to speak much more to growth, even though we have an average hourly earnings report, which will speak directly to wage inflation. We are looking for a 0.4 gain on that. But I think the message from this week is that the economy is doing reasonably well, not as strong as it was 6 or 9 months ago. We're looking for job growth to be settling here somewhere in the 150, 175,000 a month range here. And I think what you want to look here is at the pattern of behavior. As you noted, manufacturing still looks weak, but there still is broader strength in the economy outside of manufacturing. And I think the net effect of this is an economy that's growing probably around 2% right now.
So this leads to this question of the round trip that we've seen on the 10-year yield. Are we currently seeing restricted levels of rates? Are we going to see that working their way through the economy this year? Or is this really going to be something that allows the recovery or the expansion to continue?
Well, that's an interesting question because, as you know, the Fed responded to the rise in 10-year yields from the middle of the year through the end of September by arguing that that was doing some of its work for it. It has not pushed back against the easing so far. It's really embraced the idea that we can get inflation down without having to have any pain and possibly have material Fed easing. We do see the fall in 10-year yields as a reflection of risk appetite going up. You see that more broadly in equity markets. You see it across risky assets around the world. I think it will support growth. It does promote resiliency. And I think it is going to, on the margin, be a factor that's going to slow the Fed and other central banks down here.
Continuing my rudeness into 2024, Bruce, just too short an answer necessary. With you and Joyce Chang and your work at J.P. Morgan, what will be the GDP outcome of China this year?
I think 5 is as good enough a number. China is an economy which is moving in different directions in different pieces, but I think there's enough policy support. I think the external recovery we see, which is quite modest, but taking hold in tech and manufacturing will help it. I think it'll grow 5 with a very weak private sector demand and quite significant supports externally and from the public sector.
Following a pretty shaky year as well. Bruce, thank you, sir, for catching up with us this morning. Appreciate the update. Happy New Year, Bruce. Bruce Kassman there of JP Morgan. I did promise you an update on the latest out of Japan following that airline collision at Haneda Airport in Tokyo. A Japanese Coast Guard plane colliding with a Japan Airlines flight at that particular airport. As far as we understand, all 379 passengers and crew on board the larger plane safely evacuated, according to a spokesperson. The latest we're getting on the smaller Coast Guard plane, Elisa, 5 Coast Guard members confirmed dead. This according to the Japan Land Minister.
And we will be obviously getting more details as it comes in, but really just yet another tragedy on top of the already tragic images from the earthquake that we saw, as well as some of the tsunami fears this coming, as we still try to establish what actually happened here.
To the two airports of Tokyo, we all know Narita and the horrific drive. It's 40 miles from Narita. It makes O'Hare look like a walk in the park. Haneda is a newer airport, if you will, for commercial aircraft, mostly domestic, mostly northern Asia, less the international flights.
That's the latest out of Japan. More on that a little bit later when we get more updates for you. For the broader price action, we look like this on the S&P 500, pulling back by 0.7% on the S&P. An update on Apple, a downgrade from Barclays this morning. That stock is negative by about 1.8%. From New York, this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There will be a temptation to think that the three major conflict areas geopolitically that you just pointed out, Ukraine, Israel, Taiwan, are going to be somehow handled when in fact they're going to continue on for months. I mean, there's no easy end to the Ukraine war. The Israelis say that the Hamas war will go on for months, and I don't see anything there to stop it. And there's a lot of volatility around Taiwan, which I think, frankly, is underappreciated by markets.
That was Terry Haynes there, the founder of Pangea Policy. As geopolitical tensions mount and linger, the latest from Iran dispatching a warship to the Red Sea. More on that in just a moment. The broader price action, if you're picking up on things in commodities, crude looks like this. On WTI, 73.20, up by about 2.2%. Brent crude up to almost 79, Lisa, 78.71, up there by a little more than 2%.
To me, I'm watching this very closely. We've been surprised all year by oil prices declining and actually ending the year with a loss last year. This year, really key to see as Iran sends a ship over to the region. We're not seeing any sort of quieting down in some of the conflict in the Red Sea.
You heard it there from Terry Haynes. Underappreciated by markets, maybe. Tom, October crude was down 10.76%. November it was down 6%. December it was down 5.67%. They're the last 3 months on crude, even with all of this going on in the Middle East.
With all this going on in the Middle East, and it's 78.68 on Brent crude, up 2.1%, it's sort of middle tendency. I thought I'd see a bigger move over the last week, but the answer is, you know, people are using surge or lifted. Well, it's just trading up, and I think it'd be much higher. Is it possible that the United States is the #1 producer of hydrocarbons in the world?
It is the weight of U.S. output, 13 million barrels a day of output in this country. It certainly contributes to that move, Tom.
Joe Biden, Secretary Granholm, oil czars, if you will.
Yeah, except they won't talk about it. They won't talk about it.
They certainly won't talk about it to me. Oh, an inside surveillance joke. Right now, we need perspective, and we get it from someone gifted. He's served the nation in the Marine Corps, also a White House fellow. And critically, he is the king of speculative fiction with James Stavridis. Elliot Ackerman's must-read 2034. Boy, is that a must-read right now, given the Philippines, given the South China Sea. And we eagerly anticipate 2054 that you'll see in March. Elliot Ackerman joins us this morning. Elliot, this is not speculative fiction. It is reality in the Red Sea. What is lost in the press coverage?
Yeah, I think the one thing that is often lost is we have a tendency to focus kind of specifically on military events while losing perspective that all military events happen in a political overlay. You know, ultimately, these are political questions. What's going on in Taiwan? What's going on in Ukraine? What's going on in Israel? And the longer these wars play out, the more and more central the politics of the war itself become and what the outcome is going to be.
The heart of your fiction with Admiral Stavridis is things happen suddenly and then in sequence. Do we have the ships in place against these terrorists, whatever you want to call them? Do we have the process in place where unexpected bad things can happen in sequence?
I think when it comes to the Middle East and the challenges that we're seeing there, yes, we do, and that is a situation where we the United States, vis-a-vis the Iranians, we are not facing a peer-level adversary necessarily in Iran. And I agree with Terry's comments that the underappreciated conflict here is Taiwan. And when it comes to Taiwan, the United States does not have the forces in place, at least peer-level forces in place that could meet Chinese aggression across the Taiwan Straits. And that's one of the huge challenges that we face, is that the Chinese would be fighting that conflict in their backyard, and we would be fighting it from across the Pacific Ocean.
I want you to elaborate a little bit on the point that you just made, that all of these international conflicts have real domestic political implications. What are some of the ramifications that we've seen over the past year, how the conflicts have developed, and how public opinion has shaped the inaction that we're currently seeing in Congress to continue providing aid?
I think when we go around the world, if we look at Ukraine right now, I would argue that that's probably a war that's not going to be decided on the battlefield as those conditions stagnate. It is a war that's going to be decided at the ballot box. And I think in Israel, as we see this war is now extending into months, I think domestic political considerations in Israel are going to determine the outcome of their war with Hamas. And I think when we look at the United States, the elephant in the room is we have an election that's going to occur this fall. And how that election unfolds will be determinative to those conflicts. And lastly, when we look at Taiwan, I mean, in 2 weeks, the Taiwanese people are having a presidential election, and the outcome of that election will certainly affect China's perceptions on what they should do in Taiwan.
How different is the foreign policy of Donald Trump versus President Biden?
I think the foreign policy of Donald Trump is much more unpredictable. And I think the foreign policy of Joe Biden, as we've seen it, is much more, and has a much more incremental. So I don't think anyone can necessarily say what Donald Trump's policies would be on any three of these conflicts, Taiwan, Ukraine, or Israel, whereas I think we've seen sort of a more consistent approach that Joe Biden has applied.
I mean, I look, Elliot, at where we are, and it's about public service. There's a lot of people watching this across this nation that have loved ones at sea, loved ones on long tours of duty. I know that the Ford is coming back from the Mediterranean. Are we fit now in our defense budget for multiple wars? You mentioned Taiwan. Let's take our war Ukraine, our war Iran, maybe our war China. Do we have a budget near capable of meeting those three threats?
I think we have to take a very, very hard look not only at the budget and the financial resources that we're applying, but also the intellectual resources, and that's actually where I have the most concerns. Would a war against China look like a repeat of the Second World War, in which the coin of the realm in naval battle were aircraft carriers? 80 years after the aircraft carrier became the corner of the realm. And I don't know that that's necessarily the case. You know, we've seen in places like Ukraine that the Ukrainians have been very effective in sinking Russian ships of the line with shore-based missiles. And so, you know, I'm a Marine veteran. My own service right now is in the midst of doing some real strategic reset about what it would look like to fight a revisited island hopping campaign in the South China Sea. And they're restructuring the entire Marine Corps to do that. So I think there's a budgetary question, but there's also an intellectual question of, you know, what will the wars of the future look like? And that work needs to be done now, and it's going to force some American military institutions to transform in ways that are going to be very uncomfortable.
With the war of the future, Elliot, what's a more effective strategy? One that's predictable or one that's unpredictable?
Well, I think in terms of your battle plans, you always want to be unpredictable. The word I would use is one that is adaptive. Because it's very difficult to predict what the war of the future is going to be. It's most essential not to get the prediction right, but to get the posture right, so that your forces can adapt to whatever the next conflict looks like. And, you know, to use an analogy from the Second World War, at the outset of the Second World War, in terms of naval warfare, again, the coin of the realm was the battleship. And it had been the coin of the realm, the most essential platform for centuries. But as we all know, you know, Pearl Harbor, the entire U.S. battleship fleet was sunk, and we had this new platform, which was the aircraft carrier. And that platform was able to adapt and become the central force around which naval battles were fought. And I think whatever the next war is, we're going to see a similar process of adaptation need to occur. It's going to have to occur very fast, and the side that gets it right will probably be the side that wins.
Elliot, just to finish there, what do you suspect it is?
I think it's going to probably be a network of platforms. I think it's going to be unmanned ships, unmanned aerial vehicles, our ability to fight both a high-tech war and also a hybrid low-tech war when many of those high-tech systems are taken offline, and our forces' ability to kind of toggle between the two. So it's going to be very, very complex, but more of a network-centric version of warfare as opposed to a platform-centric version of warfare built around, you know, very big ships and aircraft and things of that nature.
Interesting. Elliot, thank you. Appreciate your time this morning. Always do. Happy New Year, sir.
Thank you.
Elliot Ackerman there.
Happy New Year.
U.S. Marine Corps veteran on the latest DK.
I can't say enough about his book, 2034. When the kids say to me, what book do I want to read, but I don't want to read 1,200 pages of Jonathan Spence, I say, shut up and read Stavridis and Ackerman and Stavridis. It'll be a great movie on Netflix.
So this is the reason why I'm watching ASML and some of the bans on certain technology to China, because what Elliot Ackerman is talking about is going to be fueled by a lot of these technologies that are connected to chips and artificial intelligence and unmanned kinds of high-level, not thinking, but processing of data points.
We're on totally the same page. The difference between rhetoric and policy, the rhetoric is cozy, a little bit better between China and the United States, but the policy's not changing anytime soon. Coming up, Sarah Hunt of Alpine Saxon Woods on this equity market, pulling back just a touch. We're down 0.6% on the S&P. The S&P 500 coming into a new year on a 9-week winning streak. From New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about
do?
the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, to having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
'24 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility.
What I'm excited about in 2024 is to not hang on every single word that the Fed is saying.
Powell thinks the Fed's going to be cutting rates in 2024, but it's possible that the economy could be firmer for longer.
If our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
The Fed is really unlikely to start cutting in March.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market this morning pulling back by 0.6% on the S&P 500. Before we get all excited and start talking about 2024, let's talk about 2023. Coming into a brand new year, the average forecast 4,000 points on the S&P 500. We close almost 20% higher. So let's talk about, Tom, 2024, the moves for the year ahead. Well, the conviction on Wall Street, the high 5,200, the low 4,200, a 1,000-point spread between Oppenheimer at the high end and JP Morgan at the low end.
John Stolfus of OPCO there. Sam Stovall, also from CFRA, who had a really interesting and wonderful 2023 of optimism as well. And you say, well, how did this happen? And here's the solution. There's a thing called valuation expansion. Stuart Kaiser at Citigroup with a great research note here on the valuation expansion, the PE multiple expansion that we all witnessed. John, I would suggest 12 months ago that was not predicted. And yet there it is. Look at Apple with a 31 PE.
This sets up Apple perfectly, Tom, in the pre-market pulling back. The early call to start a brand new year coming from the team over at Barclays and Tim Long, lowering our rating from equal weight to underweight. The 15 has been lackluster. We believe the 16 should be the same. We believe, Lisa, the continued period of weak results coupled with multiple expansion is not sustainable.
In the last 12 months, you've had revenue down, you've had expenses up, you've had operating income down. You've got this question of just how much is the cash flow fueling some of the gains by pouring them back into stock purchases, and how long can they continue doing that and be continued to grow stock? At this point, this to me, how did we get it so wrong? Magnificent Seven were up 107% last year. This year, people are saying all the others will come to the bat. Okay, this is still the mystery at a time where we're not getting real growth in one of the biggest names.
Yeah, but I'm going to go to the optimism side, and that is, there's a lot in common between the great surge Sir John Templeton and Dan Ives. They both were great Air Jordans. And the answer is Dan Ives is channeling Sir John Templeton this morning. Apple shares, they're on sale. That's what John Templeton, that's the language of the wonderful John Templeton of Tennessee.
Yeah, is Dan Ives saying on sale, just to be very clear?
He's saying, Dan Ives is saying at Wedbush on sale. He's modeling out a $4 trillion Apple out there somewhere.
And this is the struggle, the pain of not holding Apple. Everything that Barclays said this morning is true. Almost 99% of it is true. And it was true through much of the whole of last year, Lisa, and yet still, that stock closed the year higher by almost 50%.
And the bull case includes services. The bull case includes just ongoing recycling and ongoing re-upgrading, considering the fact that the upgrade cycle was delayed, not deferred completely. There is a question here about how any of the tech stocks are going to perform, because when we headed into the beginning of last year, frankly, everyone was saying this is going to be the area of underperformance finally. They were so wrong. So we're so wrong again, whatever the consensus is.
Number one thing I missed, Zuckerberg. I missed Meta,
big move.
Zuckerberg. He's cut and chiseled like you, John. I missed Zuckerberg in 2023.
The first comparison I've ever had with Mark Zuckerberg, TK. We'll leave that one there. Thank you. I think we're all eating humble pie on Wall Street after the year we've just had on the S&P 500 and the year we've just had elsewhere, by the way, in the bond market. Just narrative after narrative and a 10-year yield just laughing in everybody's faces and closing the year exactly where it started it. Here's the price action for you this morning. A 10-year at 395.57. Yields up this morning by 7 or 8 basis points. Equities pulling back a touch here, Lisa. We're down 0.6% on the S&P.
Yeah, and how much does higher oil prices really kind of fuel this idea of potential inflation reigniting? This is what we're watching for the week ahead. ISM manufacturing comes out tomorrow, as well as the FOMC meeting minutes around 2 p.m. At 10 a.m., we get the JOLTS job openings, which have been coming down. Again, a fuzzy number, unclear exactly how predictive this is. But if you see the unemployment rate remain low and job openings come down, this fuels the immaculate disinflation discussion. Thursday, we get initial jobless claims. Those have been increasing. I am curious about continuing claims, considering the fact that, you know, there is this feeling something has to give on the labor market front for inflation to come down. And non-farm payrolls, to finish the labor market theme, comes out on Friday along with ISM services. Do we see average hourly earnings sticky at around 4% year over year? If they are, can we see a Fed truly cut interest rates by 6 times, by 150 basis points throughout the remainder of 2024?
We're hitting the ground running in the first week of 2024. With us around the table, Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning and Happy New Year. Let's revisit that quote from Barclays this morning. We believe the continued period of weak results coupled with multiple expansion is not sustainable. Are you on the same page?
I think you almost have to be. I mean, you know, the theme for 2023 was all about the Fed and what was going to happen. And as soon as the cycle peaked, you could be okay. So if we pulled forward a lot of multiple expansion on the back of the idea that rates are going to come down, they're probably not going to come down to that great financial crisis level. If they come down a couple hundred basis points, is the multiple expansion already too much? And I think that that's going to be the big tension in a lot of them. And, you know, for Apple, which we were talking about, you've got to look at all that consistency and all that cash flow. And that's what people are paying for, that and the exclusivity of its Apple, and people will keep replacing those products.
Is that assessment true of the whole market, of just a select group of stocks that dominate the market?
I think it's more a select group. I mean, you have to, I think valuations, and we keep saying, you know, it's almost like this is Europe's year. This is valuations year. It's going to matter this year, right? I don't know when it's going to matter, but at some point it will. I think having money have a cost makes valuations matter in a way that we had 15 years where, you know, people talked about it, but it didn't really matter. Maybe that starts to happen now, and maybe people really start looking at those metrics. But I think you've got a lot of money on the table, and you've got a lot of places that, you know, got a lot of money that needs to be invested.
Frame out total return. You could go to the Bloomberg folks, the terminal, TRA is the function, and you can model in annual return quickly, 1 year back, 2 years back, 3 years, etc. And the answer is we're now addicted to, oh, I made 15%, I failed. Baloney. It's a single-digit return. At the most, you're going to make 11%, but the answer is, do we need to get used again to equity return of 8 or 9%?
I think that you do, and I think that you also have to look at history. I mean, yes, you had a huge move last year in a handful of names, and yes, some of the other stocks started to catch up at the end of the year. I was just looking at a chart of L3 Harris before I come on here, and I was like, wow, that back end of the performance was really, really quick. I don't know where you end up with multiples here, but I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at. You know, if the Fed's really going to cut 6 times like the market is pricing in, then we probably have a much weaker economic scenario than earnings are pricing in. So I don't, there's a tension here, and 2024 has got a lot of questions that need to be answered.
You're the person I've been wanting to ask this question to. One of the big surprises last year was that the great underperformance came from oil. Tom and John were talking about why that was so surprising, considering some of the conflicts that really were escalating in the Middle East. At this point, we are seeing oil perk up just a touch in relation to what's going on in the Red Sea. Could this increase, if it continues, change the disinflation narrative?
Absolutely. I mean, just changing the trade routes alone could change some of that, because you're going to have things get more expensive. But you've had a huge supply response to oil demand, and you've got, you were talking about earlier, the U.S. is a huge producer now, right? Commodities are priced on the margin. If I've got excess supply, I can't get prices to really move that high, which is why the Saudis have had to keep taking oil off the market. But if you start to see a crimping of some of those routes, and you can't move things the way you thought you could before, then you're going to see, then you could see some problems. And that's been a huge help for the inflation picture. And if that changes and you start to see data that is a little bit more inflationary, that narrative on how much the Fed's going to cut has to change. And then that's going to be a question of where do equity multiples go, given that scenario.
I know that you were bullish on energy stocks through the beginning of last year. Then you got a little more tepid as you saw some of the moves. At this point, how much are you leaning in to some of those names because of just how offsides people would be if the disinflation narrative fades and oil prices surge?
Well, we think of energy as an area where you need to have some position, but you trade around that position. And you get heavier when you think that you've got an opportunity, and you get lighter when you think that the market is not going your way. When the supply came up a lot, that's where you sort of lighten up on your energy positions. I don't think you want to be out of it entirely. You've got a lot of very good dividend yields in those, and you've got a lot of stocks that act better in a bad market than some of the other things do. So I think that's something you want to trade around, and we still think that energy has a longer tail.
You've got a barbell portfolio. You've got the short-term stuff where you're day trading. We know you're famous for that, Sarah. And then you got the buy and hold. I want you to talk to the audience that their heads are spinning off of COVID. They're stating, okay, COVID's over. Can I maintain some form of 3-year or 4-year or 5-year ownership of whatever equity I'm comfortable? Can you still do that act?
I think you absolutely can, and I think that this is a time to really be thinking about that thematic trade of what's going to happen in the next few years, right? So we look at something like Tetra Tech that does all sorts of engineering and construction, but basically on a lot of water and some of the infrastructure stuff. I think that you can definitely look at companies that have a longer-term theme that are playing into some of the things that are going on, but the volatility within that, you have to be able to say, okay, this is where I will allow some volatility to occur, because some of those stocks that that we like a lot still have had some challenges in a year where someone makes an acquisition or somebody does something. But I think you can look at thematic investing now, because you really got a longer term view, and you've got a market that's fairly expensive, so you better really like where you're positioned.
Let's finish on the banks, the regional banks specifically, not the big players, the regionals. KRE, closely followed regional bank ETF, you know them well, up almost 14% in November, up 16% in December. Is that just a leverage trade on what's happening in the bond market, in treasuries, as yields fall aggressively, or is there something to get your hands around for 24?
I think that's a lot to do with what's going on with interest rates, and I think it's also a lot to do with people looking for, okay, where has completely still been on the floor, and maybe we can pick something up here, because the valuations on that group were very, very not challenging relative to the rest of the market. I think you still have issues with the yield curve. I think it's still difficult to make some money in some of those, and I think we still have commercial real estate issues that we haven't flown through yet. So it's a little bit challenging to say that that's a definite thing about the environment, as more as like it was being picked up off the floor.
Speaking of the yield curve, Lisa, 2-year versus 10-year, still negative 36 basis points.
They're not going to really make up some of the difference through lending long and borrowing short. To also Sarah's point, $117 billion of commercial mortgage debt coming due just this year alone. That's really going to raise some questions on that front with some of these regional banks.
I read the same article. I believe it was in the FT. My brain's frozen on that right now. But the answer, John, is I saw a bar chart of, I'm going to say, 10 cities in America. There's basically New York, and sum up all the others, and maybe every other city combined is the same as New York. I mean, it's amazing how this is a local issue for us.
Hey, Sarah, it's good to see you. Happy New Year. Sarah Hunt there of Alpine Saxon Woods. If you're just joining us, welcome to the program. Equity futures on the S&P 500 look a little something like this. We're down 0.6% on the S&P 500. Yields are higher by 8 basis points, 395.94. There's one stock to watch in the pre-market, though. It is Apple. Moving lower, Lisa, off the back of this move from Barclays, lowering our rating from equal weight to underweight. The stock is lower by 1.7%.
The fact that the stock is lower by as much as it is really highlights the concern that people have out there of exactly some of the issues that Barclays have highlighted. Tom, I suggest that you're going to probably put out there, well, they've been wrong, they've gotten the move wrong, they've all been behind, all the things are true. You are correct. But this is a big mystery. When will it matter that this is not the growth stock that NVIDIA is?
I have huge trouble with this. I can't stand the phrase underweight. Is underweight a sell? I'm serious, folks. Everybody out there
directly
in Global Weiss, Terry Weissman's over in the green room where you're aging right now off this. What in God's